morning. It is Thursday, August 3rd here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. Brad Smith is off today. And here are three things you need to know this morning. Sour sentiment. Stock futures continuing their slump this morning with bonds coming further under pressure. That was spurred in part by America's credit downgrade. Fitch's shock downgrade of the U.S. credit rating slammed the stock market yesterday, and the S&P 500 had its worst day since April. Markets are still under pressure with the selling spreading overseas, contributing to losses for stocks in Europe and in Asia. Anheuser-Busch reporting a big drop in profit for the second quarter. As expected, results in North America in particular suffering from boycotts of Bud Light. Sales have fallen sharply since transgender star Dylan Mulvaney made a social media post about a personalized can of the beer. But overall, worldwide operating profit actually improved by 2% after growing profits in every other region, including a 47% jump in South America. And results for Apple and Amazon after the close will be the next big hurdle for the market's tech-fueled rally. The state of the consumer, business-to-business spending and cloud services, artificial intelligence, all of them will be in focus. Apple stock has soared nearly 50% this year heading into this report. It recently breached $3 trillion in market cap and is trading near an all-time high. For Amazon, the focus will likely be on the company's Amazon Web Services unit and whether or not growth will re-accelerate at the cloud leader. Both stocks have been a key part of the S&P 500's advance this year, but the question is, can they fuel further gains? Well, as we mentioned, futures under pressure this morning, still reeling from Tuesday's U.S. credit rating cut. Is Fitch's downgrade the break that investors and markets have been waiting for, cooling off a hotter run year to date? Or is the cut cause for serious concern? With us now is BNP Paribas U.S. senior economist Yelena Shulyetyeva alongside Yahoo Finance's Miles Udlin. Yelena, thanks for being here.
Sure.
Appreciate it. The Fitch rating downgrade is sort of still percolating, it feels like, through everyone's brains as well as through the system. And yes, yesterday it felt like it was somewhat in reaction, the action we were seeing in the market, but it also felt like maybe a little bit of an excuse for markets to take a breather, right? And we were hearing from a lot of pundits that they were sort of confused by the timing of the downgrade at the very least. How are you thinking about it?
Totally. The timing could have been very surprising, coming more than a decade after the S&P downgrade and 2 months after the debt ceiling debacle was resolved, actually. So things are not looking that bad in the near term, but this is definitely a long-term issue for the United States. So the downgrade itself is not surprising given how unsustainable debt levels are and how it keeps growing at a very rapid pace. And, not even talking about the governance issues. So I think it's a long-term issue for us, and we will be talking about this decades and decades going forward if this unsustainable path continues. This is something that future administrations will need to take care of, and if we don't, we'll just end up paying such high taxes that we will not be able to afford anything else. So I think it's an issue, and it's not surprising that they did that. The timing was a little odd.
Do you think, Yelena, that this brings the kind of fiscal conversation into more focus in the U.S., mostly because if you kind of go back to even 2016 when Trump was elected, certainly the way that both administrations coming out of COVID have viewed the deficit, which is, it's fine, I don't really care. Does this kind of get us back to maybe not the austerity enthusiasm we saw right after the financial crisis, but more of that conversation? Because it does feel like for both parties, the most important presidential candidates, most important leaders have kind of said, you know what, we're just going to spend and kind of figure it out later.
Look, fiscal policy can and should work during the times of crisis. I strongly believe in that. But, when times are good, you should start thinking about how sustainable things are. Think entitlements. Nobody wants to touch that. You have to address that one way or another. And that's a reality. That's not something that we will be able to avoid.
The outcome of all of this yesterday, or at least one of the knock-on effects, was we're seeing bond yields start to move higher, right? There's been some selling in the bond market. You look like you're doing a big sigh because you don't think that was the reason that we were seeing the action in the bond market, or what do you think?
I think in short term, what else are you going to invest in? Like Treasuries is still the safest, asset there out there. So what are you going to replace it with? That's why I'm saying this is not a short-term issue. This is more of a longer-term thing that we all have to worry about. By the time we retire, will we be able to afford, the essentials, or not even talking about some discretionary spending, and overall how the economy will do. But it will be a concern of each one of us, I think.
All right, so let's get to the week's main event tomorrow morning, where you get the jobs report, and just thinking about the state of the labor market right now in the context of an economy that continues to outperform essentially what most everyone thought we would see into 2023. How are you thinking about Friday's report, both in the context of what it means for the Fed, might do next, which is the kind of primary concern all the time, but just the general arc right now of what we've seen in the economy the last 6 months?
So I would characterize it as gradual cooling. So why gradual? Because things are still very tight in the labor market. You still see jobless claims at the levels that are very low, and there is no hint of any immediate crisis in the labor market. But at the same time, if you look at the JOLTS data that we received earlier this week, you see a gradual slowing in hiring. So it's not that companies are laying off workers. It's the pace at which they hire new workers, and that is slowing. It's at the lowest level since the expansion began. So, and back to pre-pandemic levels. So job openings are falling as well, but if you look at the ratio of openings to unemployed, it's still at a very high level, and it's showing that demand continues to exceed supply of workers by a very large degree. So, things are cooling, and this is what we are going to see tomorrow in our view. Despite the rebound that we are projecting, we are at 225, slightly above consensus. But if you plug that number into and do some arithmetics, it's still below the recent trend, the 12, 6, and 3 months average, if you look at overall trend in the labor market. So gradual cooling, this is what I call it.
So then in thinking about the Fed, you guys are expecting a pause in September. Is September the end for you guys? And I guess, my takeaway from the press conference last week was, of course, the Fed forecast, or the Fed staff has cut their recession forecast. Does that change how you might think about the SEP in September? And just where do you think the Fed goes longer term from here?
I think first of all, in terms of SEP and the meeting in September, we do expect a pause, a skip. And in November, it will probably be too late to raise rates because the economy will slow down. In terms of SEP, we think that the Fed will revise inflation projections, and they will probably revise growth to the upside. So the Fed is very high in terms of inflation projections in their latest SEP, and it looks like things are slowing down much faster. But that's what is happening. So inflation is falling much faster than they were thinking. So, and that will allow them to forego that September rate hike. So I think for the Fed, they will refocus more on the labor market. But for now, we are really watching closely any inflation reading, which we also expect to decelerate.
So yesterday, Bank of America said, we're not expecting a recession anymore. Is a recession still coming?
I think it's too early to call it off, I think, in our projection. I think there are a lot of headwinds that we will see going into the fourth quarter of this year. So you still see a lot of tightening in the lending conditions. We just got the Senior Loan Officer Opinion Survey, which is showing significant tightening in both the commercial and industrial sector and the consumer sector. So that's one thing. It's still present. So I think prior tightening from the Fed is still percolating through the economy. On top of that, you'll get student loans payment resumption in October. That will take some steam out of consumer spending. You have your excess savings, depleted by the end of the year. This is our projection. So there are a lot of things that will combine towards the end of the year to really put a brake on economic growth. Though inflation will be a tailwind.
Well, that's what I was going to ask, because we actually have had some people come on the show recently and say they expect us to see an uptick in inflation towards the end of the year, perhaps a little bit of a resurgence or reacceleration. I mean, if that happens at the same time as the stuff you're talking about, that's not necessarily a good thing.
Right. Well, look, so for now, inflation is cooling. So that is a little bit of a tailwind for the economy, for the consumer. We could see some reacceleration in inflation towards the end of the year, just on the base of the base effects and energy prices. But yeah, that could well be another headwind if it really accelerates. So I think it's still quite a possibility that growth will decelerate quite significantly towards the end of the year, and we may see a mild or moderate, whatever you want to call it, recession still, which would mean there is some pickup in the unemployment rate, unfortunately.
Yeah, well, today we got that jobless rate, at 227,000 for the week, so still pretty low level. All right, Yelena, thank you so much. Yelena Shulyatyeva, BNP Paribas U.S. Senior Economist. Good to see you. Thank you.
Thank you.
Let's get to some specific corporate results now. Qualcomm's results beating estimates in the second quarter, but a disappointing forecast from the company is sending those shares sharply lower this morning by about 10%. The company blaming a slower recovery in China and a challenging macro environment for the disappointing guidance. On the conference call, Qualcomm executives said they do not see an immediate rebound in demand here. And as we know, Qualcomm has been trying to diversify its business, but it still makes most of its money from selling chips to handset makers like Apple, which is one of its biggest clients. And revenue from handset chips was down by 25%. So not good.
Yeah, I mean, I think ultimately the chip story now has evolved a little bit in the last couple of days even. You look at what AMD said, I think it was just on Tuesday afternoon. We're all kind of benchmarking to NVIDIA coming out at the end of May and being like, oh, we're raising our guidance by 50%. And I think there's a realization perhaps that the chip cycle is always a cycle and continues to be a cycle. And after kind of these huge inventory builds, and we saw it across industries, but certainly chips, was one of the more acute sectors that saw this massive run up in 2020 and 2021 for all kinds of reasons. You had the economy, actually kind of doing this major surge out of the pandemic. You had the crypto cycle there. And now it's like, well, maybe AI will just make the cycles go away. And I think that's not quite the case, certainly not the case when you look at the stocks there. I mean, it's been a major bid, certainly looking at the ETF level here, because again, it's like a very simple, here's the AI story, but you kind of go through the call and you see the commentary, from Qualcomm specifically. And I think their view on AI is there's a lot of, everyone's doing this. They're walking back that it's going to happen today. They're talking on the call about how cars are probably their most interesting application for AI, but you and I both drive every day, and cars are mostly still driving themselves. So I think that kind of again pushes all these timelines a little bit out into the future.
Yeah, and also if you think about their mix, and this is something they've been working on a while, and some other chip makers have too. Revenue from handset chips, $5.25 billion. Automotive revenue, $434 million. So yes, they're trying to boost it up, but it's still a small part of the overall. And you also have to think that NVIDIA, which participates on the data center side of it, I think there's this realization at this point that different chip makers make chips for different things, and not all of them are going to be applicable to this huge AI thing right away. It's certainly going to happen in stages.
And we're talking specifically about the chip trade right now, but ultimately this is the case for all sectors whenever there is a bailout like AI, right? AI became a bailout for a number of different companies and a number of different industries, and for investors who were coming off a very bad 2022, it became very safe. You can buy the ETF, just buy everything in the basket and it'll probably do better than the market. And now this feels like the quarter, at least to me, kind of going through all these different calls and seeing all these different results, where it's like, oh, okay, all right. Are we sure? Are we sure that's like a today story? Moreover, if your stock is up 30, 40, 50, 150% so far this year, it doesn't take a lot for there to be a sense, and maybe Qualcomm doesn't quite fit in this basket, but there doesn't take a lot for there to be a sense from investors that I guess I should have read the call before I bought the stock, but hey, it went up a bunch. So
I know.
let me just get out of here alive and move on to the
Yeah.
next one.
Well, there's another chip maker that we should mention that has been sort of, even before the AI wave, was sort of struggling to get back to its former self, and that is Intel. Our Brian Sozzi had the chance to speak to Intel CEO Pat Gelsinger, and Soz asked him, where are you in this whole AI race? And this is what Pat had to say.
Okay, Intel, are you going to participate in that accelerator market? And, I'll just say we haven't been as aggressive out of the chute as we should have been. And now with our Gaudi product line really starting to get interest in the marketplace, customer pipeline is building very rapidly. We're showing up. We're starting to make a impact in the marketplace, but we have to prove it because we have a clear market leader who's executing very well.
So that's Intel's response there, that they're, kind of playing catch up a little bit, and we'll see if they manage to do that.
I mean, I think at this point in the cycle, it's one of the few times when it's never safe, but it's like safe-ish to say we're behind. We're catching up. We're going to figure out our thing longer term, and we could kind of go all day on the strategy around your AI strategy, but it feels like a little bit of the heat has come off the. Let me get the whole roadmap for the next 5 years today.
I mean, and the thing about NVIDIA is it doesn't report till the end of the month, so we got to wait to see if they are living up to the expectations.
Like that. I mean, like Walmart's in this bucket of they're lagged on the earnings kind of cycle.
Well, but at least all of the retailers are lagged. Like you get the other chip makers, and then there's NVIDIA way at the end.
But the thing with Walmart and NVIDIA is Walmart becomes a bellwether for the whole economy.
Right,
so you get through the whole thing, and then Walmart comes out at the end, and it's like, actually it was good, or actually it was bad.
Right,
and NVIDIA.
And they had another month. I mean, their calendar's different too.
Yeah.
So. Yep. All right, shares of AB InBev are up slightly this morning, up about 2% thanks to better than expected earnings. The Bud Light owner beat forecasts with a 7.2% increase in total revenue for the quarter. It was boosted by strong overseas sales in the Asia-Pacific market. But U.S. sales did take a hit thanks to that boycott drama following Bud Light's partnership with trans influencer Dylan Mulvaney. Revenue in North America was down by 10.5%. EBITDA was down by 28%. So obviously a big tumble there. But if you look at earnings in other regions here, overall adjusted earnings were up 5%. Brazil, China, and Colombia saw earnings rise 20%. So this really was a U.S. problem. And I won't say just a U.S. problem because U.S. is a huge market for them. So it's not like it's a small problem, but it was a limited one.
But it is a relatively smaller problem for the overall AB InBev portfolio than perhaps it seems when there is there is weekly data that comes out on how much volumes are down for the Bud Light portfolio, or the Budweiser portfolio is really the way it's phrased, in the US, because it's about 18% by volume. North America is about 18% of the overall AB InBev worldwide volume. So 9.5% volume growth in its Asia market. So that, overall volumes are down 1.4% in the quarter, so, against last year. So you are still seeing an impact overall there, but there are pieces of the business that I think investors can get themselves excited about, certainly this morning. And, ultimately, when you look at the way the stock has behaved this year, it has been a laggard in a market where everyone's getting excited about everything. And you are able to now maybe say, we can make sense of what is happening in this pocket of the business. We understand why the U.S. business is going to be challenged in all these different ways. But, another part of this, portfolio in this trade is, in the U.S., what has been the riser against Bud Light's fall? It's been Modelo. Well, AB InBev doesn't have the U.S. distribution rights, but they do have the rights in Mexico. And so as the Modelo brand on a global basis perhaps picks up some slack from Budweiser and Bud Light and related kind of plays there, they have the international play on that. Constellation gets the U.S. benefit, but internationally, and AB InBev called it out in their call, they are getting some of that lift elsewhere.
Mm-hmm. Well, and the other thing I thought was interesting is they said that the market share losses in the U.S. and Bud Light pretty much stopped at the end of April, that April to June was steady. Mm-hmm. So will they ever get that market share back? Maybe not, but maybe it's also not going to get worse. And you just have this resetting of expectations that have been priced into the stock, to your point.
Yeah, I think there's probably, maybe it's kind of a two-part story now where investors say, all right, I understand what happened here. I can make sense of it as an investor. I can get excited about all those kinds of things. You buy back stock, pay a dividend, et cetera, et cetera. But there's an operational problem maybe where, you had the number one beer in the U.S., and now you'd have the third or fourth, whatever it is. I'm not sure if there's, segment or, we've seen some marketing execs leave. There are going to be ramifications, I think, at the corporate level. But for an investor story, for a stock that's down 6% when the S&P is up 20% basically so far this year, that impact perhaps has maybe been felt, to the most extreme event for investors. And then the fallout will kind of come elsewhere in the business.
Right. My random thought of the morning, from a marketing perspective, how do you decide if you're going with LIGHT or LITE, a la Bud Light versus Miller Lite? I don't know the answer to that.
That's been baked for a long time.
Yeah,
so
it has.
Ask someone from the 60s or whatever when they made that decision.
Okay, I'll do that. Warner Brothers Discovery is the latest media giant to report earnings, announcing it lost 1.8 million subscribers across its platforms in the second quarter following the launch of Max. The company also reported a $3 million loss in its streaming segment after seeing a $50 million profit in the first quarter. Rich Greenfield, Lightshed Partners partner, is joining us now. Rich, it's good to see you here. So give us sort of your big picture take, first of all, on these numbers.
Look, they are delivering on what they said in terms of free cash flow. There's no doubt David Zaslav and team are getting the cash out of this business. They've dramatically restructured, radically reduced cost. They are generating far more cash flow than investors expected when this transaction closed last year. I think the challenge and what you're seeing in terms of the weighing on the stock today is the fact that the advertising environment is just not picking up. You had a lot of media companies, legacy media companies earlier in the year talking about sort of a second half recovery and that you'd see a ramp in advertising or an improvement. And it's improving, but off of a much lower base. And you're still looking at pretty sizable declines in advertising, whether we're talking NBC Universal, whether we're talking Warner Brothers Discovery. All of these companies are seeing the TV ad market just be terrible, recession or not.
Well, and it doesn't help if you're losing subscribers, right? I mean, how is Max? Is Max competitive?
Look, I wouldn't read too much into that.
Okay.
No, but I wouldn't read too much into that. Part of that is, remember, there's Discovery Plus subscribers in that number, and they folded Discovery Plus into Max. So when HBO Max became Max, it now includes Discovery Plus, and there were subscribers who took both services. So I think some attrition is not unexpected. There's still, in terms of the size of Max relative to its peer group, Max is doing just fine. So the stock is not down because Max lost a little subscribers. I think if anything, the Max rebrand has gone pretty well. I think the service works better. I mean, if you've tried downloading a show on Max versus the old HBO, the new interface is far better. I think this is more about they guided to the bottom end of their, they had a range of 11 and 11.5 billion of EBITDA. They guided to the bottom end of that range. They took down sort of their advertising guidance for the rest of the calendar year. I think that's sort of what's weighing on WBD as well as the sector at large, because the headwinds facing Warner Brothers are no different than the headwinds facing Disney. I mean, you saw Iger on CNBC the other day. This whole sector is facing very significant headwinds.
Rich, it got a little bit of a mention in the release from Warner Brothers today. Of course, the strike that we're seeing in Hollywood right now, impacts maybe mixed in the second quarter for a lot of these companies. How are you thinking about that longer term for the space?
Look, I'm just worried the strike is going to last until October, November. I mean, I don't sense any real progress. Yes, talks are going to theoretically restart tomorrow with the writers, but I think you've got a long road ahead. And from everyone I talked to in Hollywood, I think people are sort of prepared that we may not be fully back in action until sometime in November, even towards Thanksgiving. And that's going to be very disruptive to the business of Hollywood in Q4. And look, it also just drives consumers to watch more catalog, to watch more overseas content, to watch more YouTube. Like, this is not the right time. There's probably never a good time for a strike, to be honest. But I think given the alternatives the consumer has today versus what they might have had 10 and 20 years ago, this is far more devastating to this industry than I think both sides realize.
And I wonder how you think these different companies are navigating it. I guess what I want to ask about is leadership of the big media companies and studios, whether it's Iger, whether it's Zaslav, whether it's Backish, have these, and whether it's the strike or the slowing ad market, how are these guys doing? Are they doing a good job navigating this?
look, all of these companies were too late to embrace streaming, right? There's no doubt they waited too long to go to streaming. They saw what Netflix was doing, and they jumped on the bandwagon. Disney was the one who really started it with Disney Plus, but then everyone else jumped on it. Now they're all realizing that their core business, which is cable network, broadcast and cable networks, they're all realizing those businesses are in secular revenue decline. Advertising's going down. Affiliates, which is the fees paid by cable and satellite operators to cable networks, those fees are now going down. So the whole top line of this industry is in secular decline, and sports rights and costs keep going up. And I think that's what's spooking investors. It's why Iger's talking about spinning off linear TV, needing partners for ESPN. Like this is the sort of the sickness that's sort of plaguing this entire legacy media industry. And so you say who's leading? I think all of these executives have been caught a little flat-footed. I think, Zaslav's probably been one of the most upfront of the challenges and recognizing, hey, we got to cut this aggressively. And you see that in the free cash flow. I mean, there's no doubt they are deleveraging faster than investors expected because he realized there is no growth story left in the linear business.
Yeah, and Rich, I wanted to ask a little bit about the sports rights picture, maybe a little bit smaller for Warner than some of their other peers, but just where that fits in, because as an outsider, I see the salary cap going up for all the leagues, I see the rights projections going way higher, and yet you see the stocks and what's going on, kind of the dynamic you're talking about, it doesn't really add up to me.
Look, you're seeing it in local, right? The local sports side is imploding. If you look at Diamond Sports, which went bankrupt, it was owned by Sinclair Broadcasting. There's no doubt that local sports has imploded, and you're seeing all of the after effects of that right now. The question is going to be, is the local sports problem going to play out in national over the next few years? And look, it's possible it doesn't, because you have digital players like Apple and Amazon and even Google that have come in, Google Sunday Ticket, Amazon's bought, Thursday Night Football, you're seeing Apple do MLS and probably do Pac-12 now. But look, all signs point to if the way you pay for sports is advertising and affiliate fees, meaning the cable and satellite fees, if those are the way you pay for sports rights and those fees are going down, it is very hard to comprehend how sports rights keep going up. And that's going to be the challenge, and why the leagues so desperately need the digital players to step in, because I don't think these legacy media companies are going to be able to keep paying more for rights as their revenues go down.
So, Rich, circling back around to Warner Brothers specifically, Zaslav on the call was asked about sports. He was asked about other things like the international push and licensing content. There's whatever of these media companies you're talking about, there's a lot of different facets, right? What does he need to be prioritizing for Warner Brothers right now?
Look, I think the question is, how much sports does he really need? Can he get out of, he pays $1 billion a year for the NBA. Is there a way to create a smaller package where he, reduces costs or at least holds costs? I mean, I think that's what investors are trying to understand. You heard a couple of the questions about sports. Like, I think everyone's trying to understand, it's great that they're cutting costs right now. How much control of the cost structure do they have looking out over the next few years as these sports rights come up for bid? And can they resist? I think they're really going to look to Zaslav and hold him to it. Can he resist overspending on sports rights given what's happening on the top line?
It's a good question. We'll see. A little suspense here. Rich Greenfield, thank you so much. Always great to catch up with you. Lightshed Partners.
Thanks for having me.
Thank you. We got much more markets action ahead. Stay tuned. You're watching Yahoo Finance. August tends to be the worst month for stocks, at least if you go back the last several decades. How's this one going to go?
So I do think we're entering a seasonally weak period for the markets, and there seems to be a lot of complacency out there. The VIX is very low, the put-call ratio is very complacent. The AAII survey reached its top bullishness for the year. So all of that suggests that markets seem to be the fear of missing out. The bears have thrown in the towel. That makes me a little nervous.
All right, opening bell on Wall Street, taking a quick look at the markets as we get open for trade here on Thursday, sponsored by Tasty Trade. We see the Dow off about 0.3%, Nasdaq and the S&P both down about 0.5%. So not quite the tech lagging situation that we saw during yesterday's trading, Julie Hyman.
No, not quite the same thing. But now we've got this 2-day decline, right? Sort of, we'll see if it's a more fundamental break in the rally and the momentum that we have seen. So the 2-day chart here shows a 1.9% decline in the S&P 500. So we're going to continue to watch that action closely. I also continue to watch what's happening in the bond market, where we continue to see selling that is pushing yields higher. The 2-day increase in yields here, seeing another bump up in yields to 4.18%. That is the highest that we have seen in quite some time, going back to at least last winter, fall, for yields. And that's something that was one of the things that was putting pressure on those tech stocks yesterday. I also want to check on what's going on in oil here this morning. And that's because Saudi Arabia this morning announced that it is extending its 1 million barrel per day cut in production through September. And so that is pushing energy prices not that much higher right now, only seeing a gain of about 0.6%. But you see the action here on the chart where we saw the little bit of a spike upward when that came out. Looking at a little more detail into what we're seeing in stocks here today, hopefully we will have cooperation here. There, we get it. So as we look at the sectors here, we've got real estate that is down the most, followed by tech and consumer discretionary. Energy, along with oil prices, as well as consumer staples, are gaining the most in today's session. And then as we get to the Nasdaq 100 to see here what kind of follow through we've got from yesterday, the Magnificent Seven, they were all down considerably yesterday, or 8, whatever we're counting here. They are down again today, but in much more moderate fashion here. But you do see Amazon down 1.4% ahead of its earnings, Apple down about 0.6%. Both of those companies, of course, are reporting after the close of trading today. So we'll continue to watch them closely as the day goes on, Miles.
I'm just looking at this and it's feeling a little bit like, I know that you look at Qualcomm, it's like darker red for being down more. Yes. I think it's like it should be cardinal red when it's down only a little. And bright, like fire engine red,
be the opposite.
When it's, because I'm looking at this, I'm like, oh my goodness, what a terrible day for tech. And then it's like Microsoft is, you can see it on the left.
You can do it equal. You can do it equal weight too, and that gives us like PayPal down 10%.
So it's like now I'm seeing why the gradient exists, but you almost wonder if you kind of invert them. I'll talk to management about whether we should be changing the stream.
Jared Blickry waiting in the wings over here, listening very attentively. I see him out of the corner of my eye. He's like, listen, guy, I've thought about this. The questions are, aren't you management? That's what everybody wants.
Well, listen, some people would say, others no. All right, shares of DoorDash on the move this morning, hitting a record total orders in the most recent quarter. Stock up about 0.8%. Company also went out and raised its full year forecast. DoorDash, a company that does the thing, Julie, that I like more than any other, which is writing a nice letter to investors along with its earning release. Founder Tony Xu out with a great letter where they kind of just talk. I mean, honestly, it's just business theory, how he thinks about investing in businesses, what the long-term value of their investments might be. And I think, in this, we get to the discussion of the marketplace business for DoorDash, because you hear DoorDash and you think, oh, it comes to my door. But them setting up the suite of services for companies, they are now doing delivery, they do point of sale. And that vertical for them really being the growth driver, I think has been an interesting revolution, revolution in the company, evolution of the company, I should say, and getting away, frankly, just from the name that's on the front door of the company.
Right, that it does not just DoorDash, but like Stack.
It's a stack. Yes, it is the tech stack for a restaurant operator. And then, sure, if you actually order the delivery, you're hit with like $7,000 worth of fees, but you don't have to just do that. There are other ways for them to partner with restaurants that I think are a lot more palatable, both for consumers and for restaurants. And that, really is the growth driver. And I think over time, there's never going to not be a delivery part of this business. But, if you can almost, and you get this theory in the letter, it's the classic kind of Amazon thought around, well, this is our best business now. But what if it just wasn't? What if we intentionally tried to make something that was better than what makes us money now? And what would our company look like longer term? And I think you start to see some of the outlines, for a company that came public, had a very positive reception, had a lot of problems last year, like everybody who was public in the stock market in this kind of general space, and is now getting, kind of on the other side of that and starting to really think about what does our life look like long term as a public company?
Right. So there's the sort of stack in technology, and there's also the stack beyond restaurants, strictly speaking, right? Delivering other stuff, whether it's other food or sundries, whatever you want to call it. And it's hard to know if that's as big an opportunity as offering a bigger suite of services to its customers.
I mean, to bring Amazon back into it, the experience on Amazon's retail site, I think, has been talked about enough at this point.
But now the reporting was out yesterday that they're now changing that. They're consolidating their various food things, which makes sense because it's pretty dumb the way it exists.
So I guess, all I was going to say is, I think there's been an opening here for other marketplaces of any sort. It could be food, it could be pharmacy, it could be all kinds of clothing. There's an opportunity here for many players, and we're seeing it, across spaces, to offer a better, let's say, retail aggregation experience, perhaps, than the original.
Yeah. And then there's little players like GoPuff that are out there too, doing grocery delivery.
Yeah. Well, I mean, if you go through the letter, they talk about the example of how much money they were losing on their delivery business, but the unit economics were actually good. Problem is, there's a lot of smaller players that have lose a ton of money and don't have good unit economics on some of that delivery, and so.
DoorDash has the advantage.
We're still in the ZERP era of thinking in a lot of ways. That makes sense.
Interesting. That does make sense. All right, it's tough times for pizza. Papa John's International missing estimates in the latest quarter. The company said it saw lower than anticipated comparable sales in the quarter, cited a challenging operating environment. The shares right now are down by 5%. North American comps down by 1.4%. So international comps down by 0.7%. So people not ordering as much Papa John's, apparently.
Another kind of pandemic trade that has, the heat has come off the pizza trade for some time. And I think that, looking at their peer Domino's, that had a double interesting story, a double interesting walk back, let's say. Go back in time 5, 7, 10 years. One of people's favorite trivia things was, what's the best performing stock over the last X number of years? And over a lot of time frames, it was Domino's. They had double-digit comps, double-digit comp increases for, 20 odd quarters in a row. It was a long time that they were crushing and had this, they were the original tech play in the food place or in the food space. And I think, you have the consumer concerns here, certainly. There's a pizza-specific problem that some of these companies are dealing with. And there's likely going to be, from some corners of this trade, a read-through on, what it means for the consumer. And it probably says a little bit more about consumer preferences than it really does about the consumer health overall. But I think that point can maybe be debated.
Well, and of course, I just wanted to talk about Papa John's as an excuse for us to talk about our New Jersey pizza preferences. For people who haven't watched the show in a while, Miles and I live in neighboring towns.
Unclippable part of the show. So.
No, it's very useful information for people. And there is a local Jersey pizza is very good. I do not order Papa John's or Domino's or whatever else. Full disclosure.
I actually do not. So
yeah, I don't either.
Which might be a mild surprise to you.
Not really. Okay. We order Trattoria, which is our local pizzeria.
Trattoria in Maplewood. That's right.
That is.
I usually do the Summit location because it's a little bit easier to get to. Is there one in South Orange now?
There is a South Orange location. It's right on the main drag.
Oh, I didn't know that. It's always
packed with people, especially on a Saturday night.
There's a Trot in Maplewood and South Orange.
Correct, and there's enough for both of them to do business.
I know. We do in Star Tavern. Have you been to Star Tavern?
I have gotten from Star Tavern.
Right. Yeah.
It's delicious pizza.
Yeah, it's good. It's a very specific experience.
You only get bar pizza.
Yeah, exactly. You only get that kind of bar pizza in a specific part of the world, I guess. Even though it's only New Jersey.
I think they're telling us to move on.
Well, we still haven't gone to Bunnies together, so.
Oh, okay.
I know it's slightly problematic, I guess, allegedly, but we'll get some Seton Hall kids and we'll do a big hang.
All right, that was for all the Jerseyites who are watching. Shares of Wayfair, in the meantime, were up 16%, almost 17% this morning after soaring past estimates in the second quarter. Despite seeing active customers fall, the stock is up over 150% year to date. Is Wayfair a meme stock, Miles?
Yeah, definitely.
Okay,
it was definitely
right?
in the memes. If you look at this on a 5-year, you're going to see a meme play there, let's say. And I think it's fair to call it a meme stock. I think if you're up 100% so far this year, you are officially
in
just
be
the
a meme
basket.
Stock. Yeah. So we just talked about them beating estimates here, but revenue was down 3.4%. Average order size down 7%. There were repeat customers. Like some of this stuff looked decent, but we're seeing a number of companies this quarter being rewarded for not being as bad. And I guess Wayfair falls into that category. There was an analyst call, I think it was last week, that said that the fundamentals in furniture do seem to be bottoming or troughing, and that things are going to get better from here. So, maybe Wayfair is going to lean into that.
Short interest in the 20s to 30s%, depending on the data you're looking at. Stock, go back a couple of years, stock was trading around $300 a share, and now it's at 80. So I think, it brings up, and I know Jared's going to talk about it in a second, but it brings up a fascinating question about where are we with that whole meme, with the retail thought, with this momentum in markets, this behavior in markets where you clearly have a lot of money moving into very specific trades, which essentially stock's down a lot that people have been shorting, but I know it's a target, as a buyer. And, as someone running fast money, it's like, I know I can get a little something out of this. And sure, you're getting your pop today in Wayfair, and, that's probably enough for a lot of people to come in, move out.
Yeah, well, this is something you and I talked about on the side the other day, that sort of anecdotally looking through our trending ticker page, there have been more and more meme type stocks cropping up. And as you pointed out, and kind of implied in the comment you just made, that's not all retail investors now. In fact, there's a lot of institutional investors who have now jumped on that to try to get that marginal benefit.
Look, and to be clear, it was never only retail investors. But that
was the genesis of it. I think
absolutely.
You can reasonably argue.
And I think as we were saying too, it's like, there's so much in markets and in the economy that's like set. It's like, everyone gets paid, these dates, and then they go to their 401k sponsor and it's like, I got to buy a ton of SPY or whatever it is. So the flows in markets are pretty static ultimately overall, if you really think about it. So all these trades are made on the margins. So it took so few retail traders kind of piling in for there to be a noticeable difference. And I think those trades, and look, short squeezes have always existed. It's not like it's a new thing, but there is certainly a speed around and a flexibility with which, maybe, the kind of the new pod shop model is able to operate, and retail traders, might not be, like if you worked at a big bank for a long time and you have a personal account that's like in the tens of millions, you're probably counted as retail. Like AII called you up, but you're not really retail. You're not dumb money. Like, what you're doing, but it's so cheap now to transact, and so many people have the ability to move, again, just enough money in some of these names that it really makes a difference. The bid's not that thick in a name like a Wayfair. It's not the S&P. So it doesn't take a ton. That's why the stock's up 150% this year. And look, you started shorting at 300. Who cares?
Yeah.
You've had to probably pay up a little bit over that. You've probably tried to cover at some point. Like, there's a cost to it, but ultimately there's a lot of wiggle room on both sides of this trade. And so that's, and that's how you get volatility.
Miles Edlin.
Is that it?
You sure you don't want to hang out?
I don't know.
Longer? You got to go back to your management day job.
The last time I was here, by 9:45, we'd be in our 5th break. So I don't know I feel like I'm in the twilight zone here. I don't know this timing.
But we got to talk a lot.
No, this was fantastic. I'm just waiting for the hook, because I don't know how it works anymore.
The hook comes now, Miles.
This is the hook?
But you're welcome to stay longer.
Get him out of here. Get him out of here.
Miles Edlin,
see you
everybody.
next time.
All right, we got much more coming up. You're watching Yahoo Finance. What are you hearing most from clients right now?
They continue to ask about the Federal Reserve and inflation. That continues to be top of mind. And as it relates to portfolios specifically, they continue to wonder about fixed income, and more specifically, when they should be lengthening the maturity of those fixed income portfolios, what we call adding duration. So when should they be going to longer term bonds as a potential to add value? Because what happens in a recession is bond yields fall and inflation falls, and that tends to be good for the price of return of bonds. So they're always debating when to do that.
Shares of Robinhood are on the move, down by 9.5% after the company reported a decline in monthly active users and said the trading activity continues to slump. Robinhood did post its first profitable quarter, which CEO Vlad Tenev called a significant milestone. Yahoo Finance's Jared Blickery has the details on this one. And Jared, this is interesting, not just for the company itself, but also, as Miles and I were just talking about, kind of what it tells us about the trading environment writ large.
Yeah, I think that's going to be important. I'll take a look at the meme stocks at the end of this, but I want to get straight to the numbers. So Robinhood stock trading down in the pre-market by the most since May, and this is probably going to have to force that calculation a little bit farther back in time. And this has to do with investors looking past the brokerage firm's first profitable quarter, as you said, Julie, to the disappointment in monthly active users, which at 10.8 million was lighter than the 11.7 million expected. But total assets, that was a beat at 89 billion, as was average revenue per user at $84. Now, those are the quarterly figures, and here we have the annual numbers. We can put those up going back to 2019, with 2023 and 2024 showing estimates. You can see that the next year total assets in blue are expected to print a new high after the disappointment last year. There we go. Monthly active users are not expected to recover as quickly. Now, Robinhood's revenue of $486 million for the quarter was a beat, though crypto revenue came in line at about $31 million. Net interest revenue beat expectations, printing $234 million. And if we look at the annual numbers, estimates in this chart, we can notice a few important trends. First of all, interest income is expected to grow to more than 50% of 2024 revenue, $1 billion, which essentially assumes interest rates are staying higher for longer. That's in line with what we think about the Fed. Second, options revenue is holding steady at over $500 million. This then appears to be a structural shift in the market towards more options activity that is expected to continue in the years ahead. And here's what the charts are saying. If I could get control back here, I'm going to show us some heat maps. Here's Robinhood. Let me just chart what's going on this year. You can see, along with a lot of other stocks, we had this great run up in January, disappointment into February and March. That's when we had the internet bank panic. And then we just kind of took off in June and July, but we're off sharply from those levels. And that's because of this 8.5% loss we're looking at here. First, I want to take a look at our brokerage heat map. And this is year to date. Let me just sort by performance. We can see Robinhood is actually number one, interactive brokers up number two. That's at 25%. Charles Schwab down 21%. But a lot of these names have roared back to life over the last 2 months. That's when we've seen the S&P, not 500, but 493, really catch up. And so we're seeing a lot of this covered in here as well. Now, another thing that's happened since we saw the S&P 500 really including most of its members in the rally is meme stocks. So here's over the last 2 months, our leaders board, meme stocks up 28%. And if I actually put this on our memes board, we can see this vast array of stocks that, including Robinhood itself, there's some debate over whether or not that's a meme stock, but a lot of these stocks, including Coinbase, and that's really an exchange, not a brokerage firm so much, that's up 40%. We got Carvana up 222%. These guys are usually late to the game. It doesn't mean necessarily that the market has to roll over when we see these guys piling on, but sometimes towards the very end, and last year this was a contrary signal. When these guys were perking up in a big way, you might want to watch out, because if you're late to the game, well, that means the market might be rolling over just by the time you start buying. So I think that's a little bit of what we're seeing right now. But the big question is, how much do we roll over in the major indices? And then how much do meme stocks get crushed here? This has been a surprising bull market for me personally, because we started out at the lows last year in October with a very concentrated rally. And now that it's expanded to include a lot of things, you got to wonder, is this the new norm, or are we going to go back into sector rotation? Remains to be seen, Julie.
It does. Really interesting stuff. All the stuff about options activity, also interesting. And I should note, Coinbase reports after the close today. So that is the next catalyst, one way or the other.
You bet. And we didn't even get into crypto.
Oh, there's always time. There's always time. Thanks so much, Jared. Appreciate it. Well, employers are cutting off insurance coverage related to the use of weight loss drugs as more and more people begin to use them. Spending on those drugs can cost as much as $1,350 a month for a patient, and that's quickly jumped into the tens of millions of dollars for insurance plans when you look at it cumulatively. And that's all according to the Wall Street Journal. Joining us now for more on this and all things healthcare, Megan Fitzgerald, Grey Ghost Advisors, and a private equity investor and a Columbia University healthcare policy professor, Yahoo Finance's Anjali Kamlani is joining us as well. So, Meg, this really caught my eye this morning because we are at such an interesting cultural moment when it comes to this new class of weight loss drugs, which, by the way, aren't even weight loss drugs, right? This is an off-label use. So I just wonder kind of where we are in the usage cycle for them.
Yeah, I think we're in the early innings. I mean, this is a market and a class of drugs that could be targeted at half the population. So we have a long way to go before everyone who wants and more importantly needs these medicines get it. We also have 10 to 20 drugs in development, so there might be oral compounds before you know it here in the United States. So what you're seeing is two things. One, now that we're scaling and we're getting into more and more, we're going from thousands to 100,000s now to millions of patients, you're starting to see one, more side effects, and two, more costs. So small employers who, were having costs in the hundreds of thousands a month, you saw the University of Texas now has a $5 million bill. Most of that bill is due to these medicines. They quite frankly couldn't afford it and canceled the program. So whether you're going to see more restrictions put on these medicines, higher copays, or just flat out, we're not covering this, I think we're going to see more of that because of the expense being borne by not only the employer, but also on the patient side.
Meg, let's talk about that because I know you and I could nerd on about this all day. But so we're seeing all these restrictions. You've got the employers cutting off or restricting use, the insurers themselves requiring either prior authorization or not covering it at all for obesity, specifically that indication. And then you've got a lot of other conversations like the potential to bankrupt Medicare Part D, which some are saying is an exaggeration or on par. You've seen that in a market with all of this going on, still a shortage of the drug. What does that tell you about the demand and what we should be expecting if and when it gets covered?
Yeah, so I think it's fair to think Medicare Part D, if everyone eligible went on it, there's been a few papers to show how much that would cost. So I don't think that is an exaggeration. I think what's missing from the dialogue is the end benefit. If you were able to get obesity under control for many of these patients, what would you do for their cardiovascular health, for those that have diabetes, for those that are not exercising, musculoskeletal benefits? I think we need to have more data to show what it means to kind of get weight loss down in these patient populations. But I think it's a fair question and point that you raise, who's going to pay for it? Because it doesn't appear that the cost of the drug is coming down, which means two people get to bear that cost, either the payer and employer or the patient themselves. And right now we're seeing a lot put on the patient in terms of copay, and it's becoming cost prohibitive. One thing we don't also talk about is once you start these medicines, you're on them for life. As soon as you come off of them, you rebound right back largely to where you were, and you've also lost a lot of muscle mass. So this is something that really needs to be part of a metabolic program. One of the only programs I've seen in the nation so far has been Connecticut, that is looking to employ telehealth providers and the medicine as a holistic program to make sure you truly get the benefits of not just losing weight, but you also address nutrition and exercise.
Meg, do we know what percentage of these drugs are being used just in a discretionary fashion, for lack of a better word, off-label for people who aren't obese, who are using it for kind of run-of-the-mill weight loss, and who bears that cost? And then is there risk of a knock-on effect, a negative effect for people who actually need this stuff?
Yeah, I mean, that's what's going on right now. All insurance that I've seen covers it when it's diabetes, as it should. However, we've now crept into, as you said, off-label use, where people that don't have diabetes are running a script as if they were a diabetic, And for those that are actually using it legitimately for weight loss, are they really getting the drug based on just BMI? So some good clinicians are actually doing a full workup to even look at waist circumference and what patients have used before in addition to BMI. So I think there's a lot of leakage that we have a lot of patients who should not be on these drugs. They went on them first. And as a result, patients that genuinely need them for obesity, and more importantly, desperately need them clinically for diabetes, are not getting them because some people with cash and methods and ability to go up to a med spa are jumping the line. And that is problematic. And I think that's really why you're seeing employers and insurers quickly jump in with prior auths or even possibly evaluating canceling the program. I think it's very hard to discern who genuinely needs to be on this unless it's coming from a clinician and they're the ones doing the workup. And that's not really happening across the board.
Yeah, it seems like that. It seems pretty obvious that should be happening, but it's a shame it's not. In other healthcare news, telehealth service Amazon Clinic, now available in all 50 states. It launched last November. It's a virtual platform for users to connect with healthcare providers to treat common conditions. Meg, I want to get your thoughts on this, how it is competitively. We have seen sort of other pure play telehealth services kind of struggle, or it's at the very least a choppy business. Do you think that Amazon's competitive here?
Yeah, I think some great reporting by Angeli showed, this is Amazon getting closer to their core, using Amazon as a service or something that looks more akin to, AWS. So they've gone from Haven to PillPack to One Medical, and now they're kind of saying, hey, we're going to access a provider for you on the Amazon platform. And I actually went and used it. I tried the text messaging for an asthma drug, and I tried the medical video for a migraine drug. And I found it to be very easy in terms of it gave me 4 providers that I could use. It told me how much it costs. The video was a little bit more expensive at $75, and the text messaging had a little bit more friction. I needed to produce a recent blood pressure reading. I also needed to show what my prior prescriptions were. So there was a little bit of work on my part, which I think people in the clinical field, if I'm wearing my clinical hat, that's a good thing. We want to make sure there is a screening, that it's not so easy just to text message someone a product or a medicine that they don't deserve. So I think this is getting closer to what Amazon's core strength is around being one of the largest e-commerce providers in the nation. I think it's still unfolding. I think the comments you made earlier about grocery now trying to get its footing by consolidating assets. I think Amazon is starting to consolidate these healthcare assets around what it does really well. And that really is more of an online service and accessing their Prime membership.
What does that tell you? Your experience says a lot about what we see right now with the service. What does that tell you about who their core population is, target population is, considering they do have the broad reach of their e-commerce platform, but then simultaneously it's cash pay only. They're not in with insurers. And this kind of goes along the line of the criticisms that have built up over the years of Amazon not really being able to figure out the broader, more complex healthcare system. Do you think that there's still, this is just going to be a version 1 and there's going to be a beta?
Yeah, I don't know. It's a great point. I mean, that's the most important point. They don't accept insurance. They said yet, as if they would be planning to do that. So this is still very much a cash pay market. If you look at the 30 conditions, they're the conditions that you often see in younger people with a little bit of a chronic element to it, whether it's allergies, migraine, rosacea, dermatology, erectile dysfunction. This really is a group that normally would be using telehealth and paying cash because they have the cash. So I think time will tell whether they're going to start to really hit the Medicare population or larger larger segments of the commercial market where it would be expected you can use your insurance. A side note, though, is at the end of the process, it does allow you to send the prescription to any pharmacy you want and use your insurance. So I can send a prescription on to CVS, then have my PBM benefit kick in. I'm just not able to use my insurance for the actual clinical visit, if you will, even though it's electronic and virtual.
Megan Fitzgerald, always great to get your perspective on all of these different issues. And our Angelica Milani, thanks to you both. Well, sticking with the healthcare headline, shares of Moderna rising this morning about 3.25% after the company hiked its full-year outlook for its COVID vaccine. Remember, it's still its only marketable product. The company reported a quarterly loss and a sharp drop in revenue. Moderna generated second quarter sales of $344 million, largely due to a 94% drop in sales of its COVID shot. Total revenue plunged from the $4.75 billion it recorded in the same period a year ago, when, of course, COVID cases were still trending higher in the United States. We have some economic data that we want to get you to right now here in the United States, and that is ISM services. 52.7 is the reading. That's a little bit worse than the 53.1 that was estimated by economists. The prices paid component of this services index actually ticking a little higher to 56.8. Employment ticking a little bit lower, and new orders remaining relatively steady here when we look at the different parts of the stack and what investors should be watching here. So this is kind of in line with much of the economic data we've been getting as of late. A few minutes ago, we got the S&P Services PMI, and that came in at a similar reading of 52.3. So definitely still showing expansion, but it is interesting to see the prices paid component going higher. We still see a lot of demand for services, right, that we have talked a lot about. That is a hotter part of the economy. Not seeing much reaction right now in stocks, but we'll keep watching it. We'll watch what's going on in the bond market as well, and we will keep you posted. We got much more coming up. You're watching Yahoo Finance. Now that Fitch has downgraded the debt of the U.S., I'm prompted to ask where you were when S&P downgraded U.S. debt in 2011 and kind of what your reaction was at that stage.
So I was in London working for State Street Global Advisors at that time, and it was kind of just in the aftermath of the global financial crisis, Lehman Brothers going out of business. So the world was still exiting a very difficult period. So I think today is a lot different. The economy's growing and times are a little bit different. So the fact that we got downgraded certainly is a disappointment and perhaps not surprising, but I do think times compared to then to now are a lot different.
A little bit after 10 a.m. in New York City, this is Yahoo Finance Live. I'm Julie Hyman, and we're about 30 minutes, call it 40 minutes into the trading day. Let's take a look at how stocks are moving here. We do see declines for the S&P 500 in particular, down by about 0.4%. And this continues the two-day slump that we have seen on the back of Fitch's downgrade of the U.S.'s credit rating. Wall Street also weighing a number of earnings reports. So let's talk about a few of those. Shares of Clorox, those shares are trading up by almost 11% following a big jump yesterday on an earnings beat. The company reporting net sales of $2 billion. That's 12% growth since last year. Clorox also projecting better than expected guidance for fiscal 2024. On the flip side, we have Etsy. Those shares are down by nearly 9% on earnings, despite a headline beat on revenue and profits. Third quarter revenue guidance did miss the midpoint of the range. Etsy projecting revenue of $610 to $645 million. Wall Street was looking for $632. That is putting pressure on the stock. And shares of ConocoPhillips, the oil giant, those shares little change, down just about 0.5%. Second quarter profits missed estimates there. Adjusted earnings per share, $1.84 versus the $1.93 that was expected. That is down more than $2 a share from a year ago. Well, the latest services data just out this morning, as we were talking about, seeing slowing last month in those services numbers to some extent, and still seeing a little bit of persistence in pricing, which is interesting here. 52.7 was the read from the Institute for Supply Management. That was down 1.2 points. So still expanding here, but expanding at a slower pace. And also the measure of employment at service providers showed there was not much hiring during the month. Interesting there. Let's talk about the bigger economic picture right now with Ludovic Subran, who is Allianz chief economist. Ludovic, good to see you. So looking at this services data is actually quite interesting because, you know, we keep talking about sort of anecdotally how big services is right now, travel, activities, concerts, etc. Does this show that, you know, maybe that momentum can't last forever?
Well, I think one thing is sure is that the excess savings that most American families have accrued during COVID for not traveling, not going on vacation, not going out, is actually coming to an end as early as this September. So right in the back to school's time. So I think that's a little bit what you start seeing in the services sector compared to what we saw in the ISM manufacturing, which was very good, which is all about, you know, labor hoarding and the IRA and the CHIPS Act and everything that has been happening to reindustrialize America at a very fast speed, the so-called Bidenomics. So services, you know, you can't defy gravity for long because it's leisure spending. And we start seeing that, you know, the real disposable income of Americans is being indented by the still quite high inflation and the beginning of the monetary transmission into the cost of debt, you know, cost of mortgage and so forth into their disposable income.
Well, as you wrote in a recent note, you asked if we are seeing so-called immaculate disinflation. That is, will we continue to see that trajectory of inflation moderating without the economy tumbling into a recession? Do you think we will? Is that what it's, I mean, that's what it's looked like kind of so far.
Yeah, it's super interesting to see, you know, how, for example, there was this big discussion of whether the Fed at all is responsible for part at least of the disinflation. We do believe that the Fed is actually contributing to half of the disinflation. So it's not that immaculate. It's not that coincidental. The other part is really supply chain disruptions coming to an end. It's really the softening of the momentum. And so this is why the big question now is how long can the Fed keep interest rates high, and whether this could create even less growth going forward, especially as 24 is an electoral year. So we know, if we remember 2016, that is quite a muddle through time, right? Quite a purgatory for growth. So the question here is whether this suffices to bring inflation down to 2% year on year, you know, by the middle of next year, for example. I tend to think it could actually, because the growth momentum is really going to that direction, and all the other international pressures are coming to an end.
Do you think the Fed will raise again in September, or do you think it's going to be patient here and see if all of this is making its way through the system?
That's a good question, and I don't have my crystal ball, but I believe they may have to do one last hike, unfortunately. Why? Because there are still some sticky pressures on wages in the US. And so the Q2 numbers were really high. So I would be in the camp of a possible hike again in September. But, you know, a lot can happen by then because, you know, you've seen what happened with the Fitch downgrade, and there are a lot of, you know, discussion now about what is good fiscal and whether there's been not too much fiscal so far. So it's 50-50, but I would still think that one more hike could be needed because of still the slightly overheated and the slightly, risks of having long-lasting inflationary pressures. And we know how detrimental it is to the most vulnerable of Americans.
In a recent note, and I want to ask you about global economies, and in particular European economies, because of course you're a global economist, and you were out with a note recently looking at the U.S. GDP situation, which has been quite resilient, and the European situation, which has been less so. What does the trajectory look like there as we go through the next 6 to 12 months?
Well, going back to my fiscal stimulus point, what is fascinating is that the countries in Europe that have been plunged into recession, like Germany, are entirely due of an effort to consolidate spending. Whereas in the US, there is this, prolonged, cloud nine period with the debt ceiling. And so somehow there is a recession avoiding syndrome by spending more money. And so this is really one of the major differences we see between the US and Europe now is, of course, we don't have the same reasons to worry. I would say in Europe, we still have this energy Damocles' sword and the risk of having much more trouble, as we don't have necessarily the right sources of energy. But I would say the manufacturing sector is adapting fast. We're all affected also by, I would say, a sluggish, Chinese demand. But the big issue is both the US and Europe have been fueling a lot of the growth of the past, I would say, 3 quarters from very profligate fiscal. And Europe is a bit more anal when it comes to reducing fiscal spending, just because we have a set of rules that have been changing, but they are still there. Whereas America seems to be a bit on the way to elections again, less, concerned about those rules. And so I think that's a major ingredient of growth that is different. And that's why we are actually tiptoeing with recession all for the past, couple of quarters in Europe, whereas America is still, surfing on a soft momentum-ish type of situation.
So far, not being anal, we're like not having any limits at all, really. Not really, whether it's whichever party the administration is, they've thrown a lot of money at it. Do you agree with Fitch that is a problem? And if it is a problem, people have been saying it's a problem for a long time, and it hasn't yet been. What would cause it to finally be a problem?
Look, I think as long as people believe that the U.S. Treasury is doing their job, of course, the past, few months have been a bit weird with this idea of, the Republican Party even calling for an organized default, right? That is the ultimate, threat. But I think every saver sees that the U.S. Treasury is a safe asset. And so I don't believe in a big Armageddon when it comes to the trustworthiness of the U.S. government. So that's a little bit why there is no reason to consolidate for the sake of consolidating. And we've been through that in Europe with the austerity crisis of 2012, and we've been paying the high price for that. One of the issues is, of course, the cost effectiveness of some of the spending. One of the other issues is also how much more, industrial policy can be funded by the public money without asking really about the direct effect on growth and private sector crowding in effect. I think one of the questions now is that there's been a lot of money out of the door. There continues to be quite a lot. I mean, the IRA is $500 billion over 10 years. That's a lot of money, and a lot of companies are banking on this. Is it the right use of taxpayers' money in America? That's really the question one should ask. So it's all about the quality of the spending and the crowding in effect from the private sector. Look, climate change is a big problem, so any money, any dollar is a good dollar. But I think there are ways to make sure this is not creating too much inflation, which is also what we've seen in the US in 2021 and 22.
Yeah, most definitely. And I think the execution of all of that deployment is going to be really fascinating as it is given out. Ludovic, thank you so much. Good to see you. Ludovic Subran is Allianz chief economist. Thank you. Well, tech giants Apple and Amazon, you may have heard, they're set to report after the bell today. So what can we expect from two of the biggest names in the S&P 500? Allie Garfinkel's here. She's in town.
Hello.
Appropriately enough, hello. So what should we be looking for from these guys?
So Julie, I'm going to give you 2 key metrics to watch here. One from each company, right? For Amazon, it's crystal clear. AWS sales is where it's at. They're going to show us where the cloud slowdown is at, and it's also going to tell us something about corporate spending in the macroeconomic sense. This is going to be especially important, I think, in the aftermath of mixed cloud results, both from Google and Microsoft last week. This is a chance for a land grab on Amazon's part, I would say. Now, for Apple, also, if there's going to be one number to watch, it's going to be iPhone sales. They account for half of Apple's revenue, and they're going to say a lot about where consumer demand, I think, is really landing. There's a chance for a win here for Apple. You know, recently the Conference Board data did show that consumer sentiment is at the highest it's been in 2 years. However, those chances of a win are maybe slim. The projections are showing Apple careening towards a third straight quarter of revenue declines, which is pretty staggering, Julie.
Yeah, and it's really interesting when you heard from the likes of a Qualcomm saying that not only was demand for handset chips weaker last quarter, that they're also going to be weak for the full year. And Apple is a big client of Qualcomm. So, you know, you have to wonder what the read-through is.
You have to wonder what the read-through is. And Julie, it's a really vulnerable time for Apple, right? They're diversifying their supply chain away from China. And one of the interesting fallout effects I think we're going to see here is there's going to be more pressure on that services revenue. Now, services revenue is Apple Music, Apple Arcade, and of course, Apple TV. And that services revenue has been growing. However, if iPhone sales are down, that growth is really going to need to keep up in order for Apple to, frankly, keep meeting these incredibly high expectations that analysts have and that investors have.
Right, exactly. I mean, and the stocks have done quite well, particularly Apple, running up to this report. So it seems like expectations are high.
Expectations are high, but that revenue sliding, Apple's going to have something to answer for here if the numbers don't look good.
Yes, it will. Well, that's what we've seen in some of the other big tech firms. Well, looking forward to the numbers, looking forward to your coverage of them. Thanks so much, Ellie Garfinkel. Appreciate it. Well, we got much more markets action coming up. Stay tuned. You're watching Yahoo Finance. The market's held up pretty well. We're just coming off 5 straight up months for the S&P 500. What could derail the bullishness?
I think the biggest risk to the market continues to be the Federal Reserve. So, Julia, I think that the Fed has engineered a soft landing. They should be taking a victory lap, but I actually think they're going to snatch defeat from the jaws of victory by continuing to raise rates later this fall.
Let's do a check of the market sponsored by Tasty Trade. If we take a look at the major averages, we see them still in the red. The S&P and Nasdaq both down about 0.4%. The Dow off about 0.25%. Still, it seems a little bit of trepidation that was triggered by yesterday's downgrade that then seemed to trickle through into selling in the bond market. We still do see elevated levels for Treasury yields today. The 10-year yield, for example, at about 4.17%. Well, Lightspeed released its quarterly earnings this morning. The company saw 20% growth in revenue year over year. That was ahead of estimates. Lightspeed develops software that assists small and medium-sized businesses in industries like golf, restaurants, hospitality, retail, with point-of-sale and software solutions. So what can this tell us about the state of the hospitality sector and the consumer? Let's bring in JP Chauvet. He is Lightspeed's CEO to talk more about this. JP, it's great to see you. Let's talk first of all about what you saw in your business during the quarter here. I know you saw an increase in your gross transaction volume here, and I'm just curious your big picture read on what you were seeing amongst your clients.
Yes, thanks for having me, Julie. Good morning. Well, look, we had a great quarter. We're seeing a lot of demand for our platforms. We're seeing hospitality remaining very high in terms of people, are dining. People are going out and dining, and we're also seeing certain verticals in retail do well. Especially, luxury apparel, jewelry. So it's been a good quarter for us, and we're very happy because we saw GPV, which is our payments volume, grow 54% year over year. So a very strong quarter. And what we're seeing for now is our strategy to go after the more established merchants is paying off.
I'm curious, JP, because you guys have a lot of insight into spending trends, average ticket, traffic, et cetera. If you are seeing any changes on the margins, particularly because some of your clients are higher end luxury, as you say, are we seeing people change their spending decisions at all right now?
Yeah, I think, and when we were in New York together, we talked about it a lot. Cost of labor is going up. Mm-hmm. Wages are going up. Cost of goods are going up. So we're seeing that margins are tightening. And so ultimately what the merchants are trying to do is do more with less. So they're trying to adopt technology. They're trying to adopt platforms that can help them make their people more productive. And so we're seeing that even in the high end space. I mean, I don't think the shortages in employment in retail and hospitality are going to go away anytime soon. So yeah, and I think that's why we've seen a lot of demand for our platforms in this quarter.
And are you seeing any kind of changes though among customer behavior? Are you seeing people opt for the chicken instead of the steak, for example, when they're going out to eat?
For now, we're seeing GMV in the hospitality space do really well. And I think it's pretty much the same comment I made last quarter, which is what people need to wear to go out seems to be doing well. So apparel and jewelry and watches, etc. And we're continuing to see very strong demand on the hospitality front for restaurants and high-end restaurants. So for now, we're not seeing slowdown, but we are kind of cautious when we think about the next few quarters in the year. We think there might be at some point a bit of slowdown.
And when you talk about that cost of labor that you mentioned, of course, tomorrow's the jobs report. We got jobless claims this morning, pretty much in line with estimates. But how acute is the labor shortage at this point? And obviously, what we see on the wage front is different in different industries. In the industries that you're serving, are we seeing the same rate of increase, or is it just that wages are holding steady at a high level?
No, I think the salaries are going up, but I think the real problem is pretty much every one of our customers are looking for staff members that they cannot find. So I think there's a real shortage, and it still is there, and I don't think it's going away anytime soon. And we're seeing wages go up.
I'm also curious about the competitive landscape right now, JP. We heard from DoorDash last night, which also reported increases in its volume. And I know that that's not sort of a direct competitor in many areas, but it's also expanding what it does. You have other competitors out there. So how's that landscape looking for you guys right now?
So, there's 65 million retailers and restaurateurs on the planet. We are really focused on the more established. So the higher GMV SMBs, those that have more than one locations, that do table service. So in our space, we seem to be, doing really well. And I think the more upmarket you go, the fewer vendors you have. And the bulk of the market is really legacy systems that are underserving customers. And I think we are hearing from our customers that more and more of those established restaurants and retailers know that they need to move to more modern platforms. And I think this spans well for Lightspeed. We've seen, maybe one thing we've seen is our close rates have been doing really well in the quarter. And we've seen ARPU, which is the average revenue per customer, go up. So customers buying more technology and sales cycles are in a good shape. So we're seeing demand. And I don't know how our competitors are doing, but I'm certain for Lightspeed, there's a really strong match to what the market wants.
Copy that. I also want to ask you, and I think we've discussed this to some degree before, about AI, which is sort of less the topic du jour. It's still very much a point of discussion, but not quite as frenzied perhaps as last quarter. But where are you guys with integration of that? Because I know you were excited about sort of the potential eventual applications for something like that in the software that you provide to clients.
Yeah, so nothing has changed. We're now in full implementation mode. So we have started to implement all the AI now for our support. So optimizing support, and I think that's great because the cost to serve is going down. And actually, if you look at NPS, our satisfaction rate of our customers is going up. So that's a good thing. We're using a lot of AI now in our development teams. And we can gain the numbers I heard from our CTO is 25% productivity gains when we implement AI well for developers. So that's pretty outstanding for us. And again, this tells us we can do more with less. And then finally, the last thing we're doing with AI is more for our customers, where we're basically analyzing. We have $90 billion of transaction volume, and we're really trying now to get a lot of insights. And with that in mind, we just launched our new insights module in Europe. Which we think is gonna go really well. But again, how is that using AI? We're basically looking at the macro to help merchants call better decisions. And so we're going from a model where they're looking in the mirror and we're giving them analytics to a model where we're telling them what to do thanks to AI and machine learning. So a lot of great technology and a lot to come. But we are full-fledged in implementation of all these practices.
Yeah, that's really interesting. An interesting point, JP, because obviously we have a lot of information. The question is what to do with it. So that's helping answer that question. It sounds like JP Chauvet is Lightspeed CEO. Thank you so much. Appreciate it.
Thanks for having me, Julie. Take care.
Much more coming up. You're watching Yahoo Finance. What do you do outside of work to help keep your head on straight?
I love to read. I think anyone who's in this business just has to drink from a fire hose and read a lot. And I'd like to try to read a lot of different things.
What are you reading right now?
So right now I'm reading David McCullough's book on Truman. So I thought it was kind of an interesting, and I swear I didn't make it so it was coordinated with Oppenheimer, I promise. But it was kind of an interesting period of time. And Truman was an interesting character. So a little bit of history right now.
And you saw Oppenheimer already?
I did see it. Yeah, I thought it was very good. I don't know why anyone can't tell a story in under 2 hours, but other than that, I thought the movie was great.
Investors aren't toying around with Hasbro's stock today. We are seeing it push higher after the toy giant announced its E1 film and TV business will be sold to Lionsgate in a $500 million deal. The company also lowered its full-year guidance, blaming the ongoing strike in Hollywood. Hasbro CEO Chris Cox joins me now. Chris, always great to get some time with you here. So I think the big news out of the gate is, in fact, the sale of E1, $500 million. Why did you make the deal now, and where will you spend that money?
Well, we've been in Brian, first off, thanks for having me. We've been in a process with E1 for about 9 months now. We announced it back in November. It was just the right thing to do for the company. You know, Hasbro has become great because of play, and we're really refocusing on toys and games. We'll continue to have a great entertainment presence, but when we looked at E1 and we looked at the film and TV division in particular, there was just a lot of brands that we weren't going to make action figures or board games for, and we figured there was a better home for it.
Does this deal, Chris, help you save money?
Yeah, you know, from a high level perspective, we spend about $600 to $700 million a year in film and TV production, of which, you know, from an operating cash flow perspective, we fund about 50 to 100 million of that from Hasbro corporate. So there will be that upside for us. And then the margins inside of the film and TV division, while it's profitable, it's nominal. So it'll be immediately margin accretive to us as well. And then last but not least, you know, based on the proceeds of the sale, we're going to be able to pay down a minimum of $400 million of debt and accelerate our path to our long-term debt to EBITDA ratio of 2 to 2.5.
Got it. I want to make sure the investor base understands this. Is Hasbro out of the content game? Are you still playing, you know, you still have an eye toward bringing some of your biggest franchises to life on a big screen or a streaming platform?
Oh, for sure. Yeah, I mean, the film and TV division is probably about 85% of our entertainment revenue from last year. We still have huge brands like Peppa Pig, a lot of animation efforts, and we have over 30 projects in development across live action and animation, including future movies for Transformers, G.I. Joe, TV shows for D&D, Magic the Gathering, as well as a host of projects for our board games, including a movie that we're developing based on Monopoly with Lionsgate. I think the big pivot for us is we're going to be returning to much more of an asset-light model, where we work with the best and brightest in Hollywood and leverage their distribution platforms and their content creation know-how. And we'll focus on what we do really well, which is play.
Yesterday, Chris, I had a chance to catch up with Intel CEO Pat Gelsinger, and his company is also going through a transformation. But he said something to me pretty powerful, I think. You know, that green shoots in his business that started 3 months ago are now morphing into plans. I think he meant the turnaround is starting to take shape. Where does your turnaround stand?
Oh, I think it's palpably taking shape. You know, we entered the year predicting our first half would be down 20%. After Q1, we said it would be down 16%, and after Q2, we're down 12%. Our POS has been picking up through the year. You know, we're still not fully to green, but we're definitely seeing improvements in our toys segment. And our Wizards of the Coast segment continues to be what, in my opinion, one of the best stories in all of games. You know, we see that segment up minimally high single digits this year. And that's on a track record of, I think we have a 5-year CAGR of around 13%. So there's a lot to focus on in terms of our turnaround story and in terms of our momentum around it.
What's next in your turnaround story?
Well, I think for us, it's really for a couple things. On entertainment, we're going towards an asset light model. I think that's going to save us money. It's going to raise our margins, which is important for us. I think in toys, it continues to be driving the innovation funnel there, working with our retailers to be the best execution game in town. And then in games, you know, we're a toy and game company, but I really place the emphasis in games. That's an incredibly high margin business for us, a great growth business for us. And I think you're going to see us lean in more and more there. You know, we've got a $2.1 billion game portfolio with a better than 30% operating profit margin. You know, over the next 5 to 6 years, I'd like to see us make some material progress and continuing to grow that and keep that bottom line super healthy.
Chris, a lot of your biggest customers, Walmart, Target, you name it, are thinking about what games, what toys they will put on the shelves this holiday season. What are you hearing from for them right now? Because as we all know, before we know it, we'll be out shopping for gifts again.
Yeah, well, you're seeing a couple of our favorites right here, and some of our retail partners' favorites. This little guy, Furby, we sold out on initial allocations in the first 72 hours. So we think that's going to be a toy of the holidays. We've got some great new Monopoly collaborations. This one's based on Super Mario Brothers, but we did one with NBA Prism, which basically vaporized in the first half of the year. And probably one of the games I'm most looking forward to in the back half of the year is our first collaboration with Mattel on Barbie Monopoly. So taking one of the biggest names in games with one of the biggest names in dolls and really having a nice giftable moment. And then, across the portfolio, whether it's action figures with our hit movie for Transformers Rise of the Beasts, or just other new games that we're doing like Twister Air, I think there's a lot of reasons for optimism in the back half for us.
Chris, you mentioned the Barbie movie, and really it's sucked the air out of a lot of different things. Clothing at Gap, at fast fashion retailers. Do you think it has sucked the air out of just toys unrelated to the Barbie movie? And does that hurt a Hasbro this holiday season?
No, I mean, what we're seeing is the toy category is starting to pick up a little bit. Our POS has been positive, especially when you X out kind of exited licenses for the past 4 or 5 weeks. Transformers Rise of the Beasts, we've had an 83% pickup in point of sale since the release of that movie. Spider-Man, since Across the Spider-Verse, we've had a greater than 100% pickup in point of sales. And then again, we're selling new items like Furby, which retails for around $60, and that's selling out instantaneously. So, I give my congratulations to Mattel. I think they really did a fantastic job with that movie, and particularly the marketing campaign around it. And I think if anything, that movie isn't sucking the oxygen out of the category. It's proving how vital the category is and how important the IP is.
What movies do you think will drive your business over the next 12 months? I've talked to a couple analysts, and I'm starting to hear a change in tone in their voice, Chris, regarding potential franchises that may start to drive your business again outside of Transformers.
Well, I think Transformers has done a good job, and I think we'll have a nice pickup in holiday based on that. Spider-Man Across the Spider-Verse will have another pickup in holiday as well. We're looking forward to a new Avengers movie next year. We have another Transformers animated movie coming out next year. And then, I think video games is a big moment for us as well. We've got a new video game coming out today from our partners at Larian called Baldur's Gate 3. I mean, that's going to be one of the biggest video game releases of the year on PC and PlayStation. Should be a game of the year contender. And in terms of our D&D business, I mean, that's a huge catalyst for that business and an important partner for us that we wish all the best for.
Chris, I figured while I have you here, I may just admit to you, I used to collect a couple Furbies. I'm all about full disclosure.
Oh, nice.
Here. Yeah, I might have to get back into it. I see that one continuing to look at me on the screen. Chris Cox, Hasbro CEO, good to see you. I'll talk to you soon.
Thanks, Brian.
All right, appreciate it.
We'll send you a Furby.
Okay. All right, Furby fan out. More market analysis straight ahead.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
Traeger shares are lighting up today after the grill maker handily beat revenue estimates, even though it did see a 14.4% drop in year-over-year sales. The company also raising its outlook, now expecting revenue of $585 to $600 million this year. Jeremy Andrus is joining us now. He's the CEO of Traeger, and our Yahoo Finance executive editor, Brian Sozzi, is here as well. Jeremy, it's good to see you. Thanks for joining us. You talked a lot on the call, and you have talked a lot about sort of where we are in the grill cycle, right? You are one of the many, many companies that saw a pull forward of demand because of the pandemic, and now there's this long tail of normalization and stabilization. Where are we? It sounds like on the call that you hinted we could be getting to the end of that.
Yeah, it certainly feels that way. If you look at the industry in 2022, down mid-high teens. You look at year-to-date 2023, down low mid-single digits, and so it feels like we are finding the bottom. And the good news is that this is an industry that is resilient. Americans have always grilled; they will always grill. In fact, the grill-owning households grew from 75 to 76 million during the pandemic. And so, we're currently in this trough significantly below the size of the industry in 2019 pre-pandemic. It will recover. It will grow. It's just what Americans do.
Jeremy, I was in Home Depot a couple months ago looking for a grill, and I'm walking down the aisles and I see a griddle with the Traeger name on it. Why did you get in this category? And I thought Traeger was supposed to be known for wood smoking.
Brian, Traeger is known for bringing people together around these incredible food experiences. Our mission really is to help our consumer create bonds and memories in their homes and in their backyards. We built a griddle solution because we thought it was a perfect accessory to a wood pellet grill. We thought it was a perfect complement. A wood pellet grill, low and slow convection heat, and a griddle, hot and fast. And you just cook differently. Sometimes you cook together. Sometimes you cook different foods, smash burgers, stir fries, breakfast foods, Philly cheesesteaks. And so we went out and we talked to our consumers, and we really built this phenomenal innovation that is called the Flat Rock. We love it. It's so much fun to cook on.
And as always, the video that we showed during your segment is making me very hungry, Jeremy.
Hell in the studio.
And it sounded like the Flat Rock is selling quite well also, right?
It is. It is. We came at it from a fairly disciplined point of view. This is the first non-wood pellet grill cooking product that we've launched. And, frankly, we launched it when we were in a high inventory position. We said, we're going to be very disciplined. We're going to see how the market reacts to this. The good news is we can't build these fast enough. And I'd sure rather fix that problem than a demand problem.
Jeremy, I have a newsletter going out tomorrow morning around 7 a.m. looking at, what companies that have been working through transitions and restructurings, where they are right now a year later. Now, your company has been going through a transition the past year. You're cleaning up inventories, starting to get margins back under control. What inning is your company in trying to turn itself around?
It's a good question. Look, I want to start by saying how proud I am of Team Traeger. I have never seen such alignment on a team. I've never seen such willingness to do the heavy lifting and work through what's been a tough environment. Good news is, we grew EBITDA year over year. We brought our inventory levels down. Channel inventories are super healthy. Balance sheet inventories we brought down 26% sequentially from the last quarter. And so I would say we have turned a quarter. We truly have turned a corner. And what I think is important to note is that we are in 3.5% of the 76 million households who grill. You look at our heritage markets like Utah, we're nearing 20%. We are a disruptor. We are a share taker. We had to get healthy first from a balance sheet perspective. We are healthy. We will begin to lean into this now. And we know that once a consumer comes into the Traeger hood, that consumer is passionate and evangelical. So spent 18 months of playing a little bit of defense, but we never took our eye off the ball, which is to play offense longer term. And we've been making investments behind the scenes that will help us win.
I just love it so much that you call it the Traeger hood. It gets me every time. It is not a cheap club, though, Jeremy, is it? I mean, it's gotten less expensive. You've talked about how you've brought the pricing down a little bit from the pricing power that you had during the pandemic. And so, yes, you've got a small penetration and a potentially larger penetration into the U.S. grill market. But, how much are people willing to pay for a premium grill experience?
You know what? We've seen some interesting consumer disruptions in other categories over the last 10 years. And I think those are important to note. Oftentimes what's happening in a category that's important to consumers is that the consumers are being underserved. There is not innovation. There's not a reason to pay more because the experience isn't improving. This is, in a prior life, I built a headphone company, and headphones consumers were spending, dollars, not hundreds of dollars. We created a reason for a consumer to invest more, to have a better experience. Grilling is an incredibly attractive category. And we think the same thing has happened. We think consumers have been underserved. It's been a race to the bottom because it's been all about cost and price. And we are bringing innovation that a consumer is willing to pay for. And when you think about, what do we do every single day? We cook and we eat, and that's something worth investing in. I would highlight brands like Yeti. I mean, this is a whole new category that Yeti created, and it was an innovation that consumers got excited about. We aspire to really inspire our consumers to have these incredible cooking experiences, not only to create great food, but to go from hating to cook to loving the experience of cooking and sharing with families. And we think a consumer is going to reprioritize discretionary income and pay to have the experience.
Jerry, follow me on this one. With costs coming down for a lot of companies, I imagine coming down a little bit for you guys finally, is there a way to make some form of holy grail barbecue, $400 to $500, that does just absolutely amazing things, blows people away? Because when I go into these stores, and what I found is some of these prices on Weber grills blew me away. I mean, we're talking 4-burner grills, $1,500, and I don't see any innovation in some of these products.
Yeah, look, you get four burners for low price point, but then you have to taste propane when you eat. Look, the innovation is it's not free. With that said, we're building a business that allows us to create scale in innovation, and then we can progressively deliver more value to the consumer because we have scale in the upfront development innovation, scale in manufacturing as we grow. Our goal is not to be expensive to consumers. Our goal is to be accessible. And the more that we grow, the better our team becomes, the more we can deliver this incredible experience and just more value per dollar spent. That is our ambition.
Jeremy, it's great to catch up with you. Jeremy Andrus, Traeger CEO, head of the Traeger hood. Let's call him that as well. Yahoo Finance's executive editor, Brian Sozzi, joining us as well. Happy grilling to you, Jeremy. Well, thanks for hanging out for that.
I'm head of the Tomahawk Club. Love me barbecuing some tomahawks.
I know you do.
You see my picks. Love me some tomahawks.
Yes, I know that. All right, we got a lot coming up on Yahoo Finance Live. Here's a look at what's on deck. No grand slam for Denny's, the diner chain, missing estimates in the latest quarter. We're going to speak to the company's CEO in our 11 hour and get a pulse on the consumer. Sozzi loves the pun work over here.
Diner right there.
Yeah.
Love me some Denny's.
And glass half full, the Bud Light boycott cost AB InBev, but not as much as expected. Customers, though, are not wearing beer goggles. Is the company doing enough to bring the brand back in good standing? We're going to talk to 2 marketing experts and get their takes. And we've been talking about it all morning. The biggest test for the market's going to be after the bell today with Amazon and Apple on deck. Both stocks have been a key part of the S&P 500's advance this year. Can they fuel further gains? Yahoo Finance's Kiko Fujita and Diane King Hall are going to break those numbers, bringing key analysis after the bell. It's going to be a big day. We got to leave you here. Jared Blickery's got you for the next hour of trading.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery, and here's what I'm watching today. Breakfast goers didn't overwhelm for Denny's this quarter. Maybe they just whelmed after earnings missed expectations. We're going to speak with the CEO of Denny's later on this hour. And Anheuser-Busch reporting a big drop in profit for the controversial second quarter, but the company's fallout means for the future marketing efforts. Plus, a challenging macro environment is hitting consumer wallets. We're going to speak with direct-to-consumer company Solo Brands on the back of its earnings this hour. But first, let's get a quick check of the markets and let's see what kind of day we got. It looks like we are down again. Nasdaq is the least bad, least dirty shirt in the house, down 14 basis points. The Dow is down 125 points, and the S&P 500 down about 1/3 of 1%. And let's take a look at the Treasury market as well. We've seen that on the move recently, and we can see another update. We have the 30-year, that is just exploding to the upside, up about 14 basis points to 4.31%, higher now than the 5-year. That is a new development. And look at the 10-year at 4.18%. That is up 11 basis points. Well, the market's year-to-date rally was diverted recently by Fitch's cut of U.S. credit. As investors digest the downgrade, could the market's positive momentum further derail in August? Ines Ferre joins us now with a look at what we can expect.
Yeah, Jared, and if we take a look at trends, all trends point to perhaps a lackluster August, a doldrum in the summertime, let's say. We took a look at Bloomberg data and also data from Stock Traders Almanac, which shows that August is the second worst month historically when you take a look at the last 3 decades for the S&P 500. And we've got a chart to show you August's performance. Also, when you take a look at August when it comes to performance in the Nasdaq, the Russell 1000, the Russell 2000, also the second worst month. Now, keep in mind, last year, the Dow Jones, the S&P 500, the Nasdaq were all down in August. Of course, we were going through a bear market last year. But dating back even further, if you take a look all the way back to 1950, the S&P 500 has historically generated average and median gains in August of 0% to 0.6% respectively, and that's according to LPL Financial. Also, we have to note that the August before a presidential election also points to a lackluster month. In fact, all 5 indices that I mentioned earlier, those declined in the last 3 pre-election years in August, in 2019, in 2015, and 2011. And Jared, you can pull up the Wi-Fi Interactive to show what we have been up to in the last couple of sessions, because we already are seeing a weak start to the first days in August. A perfect storm, as one of your guests said yesterday, for a pullback. Now, the market is overbought, is what some strategists are saying. You've got longer duration yields. You have the 10-year yield that hit 2023 highs, and also relatively weak seasonal trends. So all of this is pointing towards a pullback.
All right. Well, we thank you for that. And by the way, that was J.C. Perez who gave you that delicious quote yesterday with us. Thank you for that, Ines Ferre. Now, with the market's upward momentum momentarily derailed by a cut to the U.S. credit rating, what should investors be looking to build or sustain with regard to wealth? So joining me now is Anthony Siccaro, president of Providence Financial Insurance Services. Thank you for joining us here. Let's answer the topical question here with respect to retirement, please.
Well, I think that there's one thing that we have to be careful of, and that is we're not out of the woods yet. Some of the conversations I've had with clients, is they feel like maybe we're not going to have a recession. So I want to caution everyone first that a recession could still be around the corner. We do have an inverted yield curve. But how to build wealth with investments is what I'm recommending to my clients is to focus on income producing investments. You know, when you look at the market history, the fact is there are long periods of time where the market has no growth, followed by long periods of time where the market does really well. And we've just come out of a 13-year period starting in 2009 where the market's done really, really well. And a lot of analysts, a lot of professionals, including myself, are thinking that the next decade may not be so good. So you have to invest for what you know you can count on, and that would be income. dividends and interest. If you have an income portfolio and it's diversified with high quality companies, you can count on your income. If you're a senior living on your income, you want to be living on the interest and dividends so you're not cannibalizing your principal. And if you are in the accumulation phase of life, growing your portfolio, then the dividends allows you to get paid while you wait. So you can grow your portfolio through dollar cost averaging the dividends back in. It's a good strategy for saving for retirement. And it's also a good strategy to reinvest dividends and interest back into your portfolio, dollar cost averaging. Great strategy.
Let me ask you, does it depend on demographics here? Does it depend on your age, how many years, decades you have until your retirement? Is this a strategy for everybody?
No, it's definitely, well, let me back up. It does depend on your age. Yes, 100%. If you have 10 or more years to retirement, you can be more aggressive. You can have a higher equity portfolio. I would think that waiting for a pullback would be a good time. I wouldn't get in everything right now, but dollar cost average in. If you have 10 years or less to retirement, you need to start pulling back. A big mistake retirees make is they wait until the day before they retire to make a change. And for the last decade and a half, they've gotten away with it. But for the next decade and a half, maybe not. And if you are retired, you got to really focus on income. At least cover your income needs through dividends and interest, and then you can invest the rest a little more aggressively if you want to.
Makes sense. Any assumptions here based on an interest rate that stays higher for longer? And where I'm going with that is markets are expecting the Federal Reserve to hold interest rates at these higher levels. But for instance, if we did get a market crash and we did end up cutting by 400 basis points, as is pretty customary during recessions, what then?
Yeah, that's a big question that I'm having to address with consumers. And it's likely that that's going to happen. It's likely there is going to be a correction. There could be a crash. And I want my clients to plan for the worst case scenario. And a mistake that I think a lot of consumers are making is they're jumping on the short-term bandwagon with long-term money. They might be investing in a one-year CD at 4 or 5% or a two-year CD at 4 or 5%, not realizing that what they're doing is they're going to enjoy that interest rate for 1 or 2 years. If the market crashes, we have a 400 bips drop on the Feds and their CD matures in a year, they might only be able to get 1 or 2% on that CD. So it's a great time to invest for fixed income because not only are fixed income investments depressed at this point, the most depressed they've been in over 40 years, you can use fixed income as a capital appreciation play and lock in higher yields, not just for 1 or 2 years, but also for 5 or 10 years. So putting longer term money in shorter term CDs is a big mistake. But I see that happening. I'd caution consumers not to do that.
Yeah, well, I was just remarking earlier, I don't know if you want to go 30 years out on the curve, but that is now paying higher than the 5-year again. That's probably fodder for a different conversation, but I want to talk about 60-40. Last year was the worst year for 60-40 in decades. What should investors be thinking about in terms of market mix portfolio balance? Is it safe to go back to 60-40, or is that kind of a dead paradigm given the new interest rate structure?
Yeah, great question. 60-40 has been talked about a lot. I think the answer to that question really goes back to what we spoke about a few minutes ago, and that is, what stage of life are you in? The whole point of a 60-40 portfolio is if the 60% drops, the 40% goes up. If the 40% drops, the 60% goes up. You've got this inverse correlation with bonds and stocks that is supposed to be the way it works, but for the last few years, it hasn't worked that way. So 60-40 portfolio with interest rates going up and the stock market going up, has not really worked the way that investors have hoped. So it does depend on the phase of life that you're in. The 40% provides more income. If you're a little bit older, I think flipping that around, maybe even going a 40-60 portfolio, 30-70 portfolio, if you're living on your income and you got to be more conservative. But if you're in that accumulation phase of life, you can even go more aggressive than that 60-40.
Want to talk about geopolitical uncertainties. We've had at least a war over in Ukraine with Russia. We've had China reopening delayed. We also have growing antagonism with respect to the tech culture between the U.S. and China. How should investors be thinking about this and navigating a less safe world that it seems that we've emerged in?
Yeah, it's a great question. And I think part of that conversation comes back to AI too. We're getting a lot of questions about this AI craze. And a lot of investors want to know, well, how do I get in on that? What's the one company? What's the Apple that I can buy that, in 10 years is going to be, take my $10,000 and make it, millions of dollars like that would have been if you'd have bought Apple 30, 40 years ago. And I'm going to just caution you, don't chase a company. You want to consider AI and what companies are doing with AI. But you got to be really careful. When it comes to the geopolitical uncertainties, that's another thing that you have to keep in mind as well. But you can't avoid them. You can't avoid the tensions we have with China. I had a client come to me recently and said, I don't want anything China. Well, good luck. You're not going to be able to invest in anything that's not going to be relevant to China. So it's something in the background. It's one of the pieces of the puzzle that you've got to consider, along with interest rates, along with potential recession, along with investing for income. So it's definitely a big piece of the puzzle.
Yeah, it seems the deglobalization trend is kind of beginning, but we are still completely connected and interdependent here. Really appreciate your insights. Thank you, Anthony Siccaro, President of Providence Financial Insurance Services.
Thank you, Jared.
Time for today's trending ticker, PayPal. Down over 10%. You can see almost 12% there, having the worst day since right after reporting disappointing gross profit and adjusted operating margins at 21%, which was below expectations. Jefferies cut its price target at the payments firm, which was founded by Elon Musk, by the way, decades ago, to $70 from $75 while maintaining a hold recommendation, saying they don't expect a positive narrative until gross profit growth improves. Now, likely in the fourth quarter, UBS is maintaining its buy recommendation, but lowering its price target to $107, and that is all the way from $118 on margin and transaction take concerns. The firm is saying that the next catalyst for investors likely to be their next CEO, with that process underway. Now, the stock is now trading at mid-June price levels in the mid-60s and is now down 80% from its July peak 2 years ago in 2021. Another pandemic high flyer that was brought down to earth and is just trying to find its footing now. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
August tends to be the worst month for stocks, at least if you go back the last several decades. How's this one going to go?
So I do think we're entering a seasonally weak period for the markets, and there seems to be a lot of complacency out there. The VIX is very low, the put-call ratio is very complacent. The AAII survey reached its top bullishness for the year. So all of that suggests that markets seem to be the fear of missing out. The bears have thrown in the towel. That makes me a little nervous.
Let's do a quick check of the market sponsored by Tasty Trade. We got the Dow leading the way down, though it's only off by almost 100 points. S&P 500 down 0.25%, and the Nasdaq down about 5 points or 3 basis points. Denny's came out with its second quarterly earnings. The company saw a miss on its revenue and EPS, but its operating revenue grew 1.7%, and its system-wide same restaurant sales grew 3% compared to last year. So what can we glean from this about the state of hospitality sector and the consumer? We're going to bring in Denny CEO Kelly Valade and also Yahoo Finance's Brooke DePalma to discuss more. Thank you for joining us here, Kelly. Just please give us your rundown of your latest earnings.
Yeah, thank you. Thank you so much for having me. So I'd be happy to. It was an interesting quarter, as you can see, and as the headline reads, we did have miss on some of the expectations that we had, but we still had and reported 3% positive sales. We reported pretty decent earnings overall, and we did beat the consensus on that. So, you know, we sequentially improved throughout the quarter. We felt good about that. This is a time where we're seeing a lot of things work in our favor in terms of commodities and disinflation, hopefully eventually deflation. But at the same time, there's still some uncertainty from the consumer as gas prices go up and sharply as of late. We still see some reason to just be cautious. The good news is, and what we did talk about on our earnings call was just the incredible playbook and the strategy that we've got for both of our brands, both the Denny's flagship brand and then our new brand, Kiki's Breakfast Cafe, which will be a huge growth vehicle for us. So we've spent a lot of time integrating that new brand into our portfolio. We're thrilled with the progress that we've seen there. And we're really excited by both what we have in front of us and in store for Denny's and Kiki's Breakfast Cafe.
Good morning, Kelly. So great to be with you. I mean, really, this past quarter, you guys doubled down on strategy. You returned the Super Slam. But break down for us exactly what you're seeing consumers' spending habits change to this past quarter. Are they flocking to those value offerings? And in turn, are they then ordering less?
That's a great question. I appreciate that so much. There's a lot going on there. But what we do see when we return to our Super Slam offer, it was a $7.99 start point. It's a fan favorite for us. And we know our guests and our consumers need value. They count on us for that, right? We have value leadership in the space that we play in. So our fan favorite Super Slam did really well for us. Again, sequentially, we improved through the quarter. That had a big part of it. We're back on actually right now talking about our Super Slam offer, and we'll continue to refresh that messaging with some innovation as well. We had a great bacon obsession spot called Baconalia that we also offered this quarter along with Super Slam. So we had both things at play. And what we saw was that the guest, to the core of your question, the guest did not trade down. They actually, we did well with our check. Our check growth was modest, but we did well with check. And so we saw people coming in, perhaps because they saw a great offer on our Super Slam, again, a fan favorite, but they came in and they were still excited about some of the innovation we had with our Baconalia LTO.
And speaking of bacon, I mean, we've seen bacon prices sort of fluctuate over the past year. You alluded to it earlier, but commodity prices coming down from 10% to 1% this past quarter. What's costing more these days? Is it that bacon? Is it eggs? And where do you hope to see those go in the second half of the year?
Mm-hmm. Actually, so we had we've got a lot of things locked in. A lot in our market basket is locked in. So we came at this promotion actually at a really good time for us. So bacon prices and pork prices down. Egg prices had started to moderate prior to this. So we had some good things working for us. And again, we've expanded our margins this quarter at a time where, you know, others may have not, but we expanded our margins and we were pretty thrilled about that. Potatoes continue to be, and that's something you see on a lot of our plates, whether it's our amazing hash browns or our amazing wavy fries. Potatoes are still a commodity that has not yet come down, while the other things in our market basket either are locked or have come down quite a bit.
Hey, Kelly, you mentioned your acquisition of Kiki's a little bit earlier, recent one, and smallish in size, about $82.5 million. I'm looking at 52 domestic restaurants there. Tell us, please, what you're thinking about. Is this a new direction you want to go? Is this just, or is this just diversification of your offerings?
A bit diversification of our offering, a bit opportunistic, really strategic play at a time where in family dining, while there are a lot of mature brands in family dining, us being one of them, we're celebrating our 70th anniversary right now. We're 70 years young and have so much potential ahead, as I indicated in all of our strategies and the things that we are doing. But the Kiki's Breakfast Cafe acquisition was a really great move into a different segment. So we now have family dining, and we now have this breakfast day parts, breakfast cafes, daytime eateries, and they're only open 7.5 hours. And for the Denny's brands, what we saw was a huge opportunity for a newcomer in the market in this segment to compete and really go head to head with others that are out there. It's a fragmented segment. This new AM eatery, though there are probably 1,000 new units in the space, is pretty fragmented. So for us, it was about leveraging what we know about breakfast, but also our great franchisee network and the fact that we are a model franchisor. So we feel like speed to market can be something that's really a strength of ours in acquiring the breakfast cafe. And we've seen really great things so far. We've got lots of interested Denny's franchisees. We opened a restaurant last week. We'll open one next Wednesday, another breakfast cafe. So we're really excited with the progress that we've seen and the potential that this brand holds for us in terms of growth.
Well, the in-house coffee beans definitely sound like somewhere I need to go to and check that out at Kiki's Breakfast Cafe. But when you're thinking about filling staff for these restaurants that are set to open, I know that you noted in the call that wage growth has moderated. We're seeing that particularly within Florida. I know you mentioned where challenges are still there in terms of staffing. So break down how you ultimately aim to recruit and maintain talent, offering maybe the best in the market as we're seeing that labor recover.
Mm-hmm, absolutely. So I think the way I phrased it in our call just a couple of days ago was the fact that though it's better and though there's been moderation, certainly in wages, you've still got different states taking pretty big wage jumps. And so that's absolutely impactful. For us, we're really confident, not only in our complete kind of employee value proposition, we've added different levers as of late. Our GAIN program, we actually announced that. We put a release out in regards to that because we're doing things that I think others aren't doing, that we know others aren't doing. And so it's about wages. We've got industry-leading turnover. We have industry-leading turnover and great retention at our company restaurants. Many of our franchisees do as well. But we're adding programs in like GED, the opportunity to get GEDs, the opportunity to get college credits with going through our management training program. We're doubling down on other offerings just to have a great value proposition. You really do need to do that today. It's incredibly competitive. And so there's some choppiness state by state, but overall, we're really happy with the way we take care of our employees. Happy we live our purpose every day, and happy they help us to deliver on a great guest experience.
And I think what's so fascinating about Denny's is that late night versus day part. And what I found so surprising this past quarter is that you guys did see a higher interest in coming during the day to Denny's than at night. When you think about the consumer behavior in that way, did that surprise you, or is that a trend that we're seeing?
Yeah, we actually still had really strong late night growth as we got back more restaurants back open to 24/7. So we spoke about our 24/7 a return to over at this point 75% of our system as a huge win. There is no one else in family dining. And I would dare say even in quick service or fast food restaurants that has been able to get back open in those late night hours. And at 75%, we absolutely have secured again our position in the market as an industry leader. And that's a core equity of ours. We know people want to count on us for maybe that great late night meal, great late night option in a virtual brand. So we're pretty pleased with that. And we saw day part growth all throughout, but late night's still growing for us as well.
Well, I'm glad to see late night back 24/7. Just a sign finally that nature has healed. And happy birthday, by the way, 70 years for the company. Thank you for that, Denny CEO Kelly Valade and Brooke DePalma.
Thank you so much.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. AB InBev dropped its second quarterly earnings this morning. While its global revenue and EPS weren't staunched, its U.S. sales, they took a massive hit following the Dylan Mulvaney controversy. Let's bring in now Yahoo Finance's Brooke DePalma to give us some more insights. Brooke.
Good
Please,
morning.
Yeah, lay of the land here. Good to see you again.
Lay of the land for sure. I mean, this was an hour-long call that really kicked off with that performance here in the U.S. It was mixed results overall, beating analyst estimates for earnings, but did fall short on revenue. And here in the U.S., once again, top story there. Revenue in the U.S. declined by 10.5% in the months from April to June, largely led by that poor volume performance of Bud Light. Now, Anheuser-Busch InBev CEO did kick off the call with this, really a frontline perspective or first insight that we're really getting to the full breadth of the impact of that controversy that kicked off back in April. And he did say that since April, the brand has engaged with 17,000 consumers. He said that of those that they surveyed, approximately 80% found that Bud Light is favorable or neutral. And they also said the consumer is at the focus and the center of everything that they do. But he did mention 3 points of feedback that they've gotten. Take a listen.
1, they want to enjoy their beer without a debate. 2, they want Bud Light to focus on beer. 3, they want Bud Light to concentrate on the platforms that all consumers love, such as NFL, Folds of Honor, and music. We are taking the feedback and working hard to earn our consumers' business every day across the world.
And now, in terms of market share, they did say that they're seeing a more stable scenario here in the U.S. over the week of July 23rd. Market share was down 5.26% year over year, but that's slightly up from month to date. And the company really doubling down on beer being for everyone here, beer being in terms of an entertainment business and really there for folks. And in addition to that, the company really, doubling down on providing that support to their wholesale partners over these past few months and really focusing to move forward from this controversy.
And when it comes to margins and pricing, we know that's always in focus, especially in the high inflationary environment that we remain in. What can you tell us about that was on the call and in the report?
Yeah, well, they did say that they took 2 price increases last year, given the size of inflation and cost. But what I find most interesting here is that the company did say that those rebates that got a lot of coverage in the news over the last month or so was actually in line with seasonality. It's something that they do over this time of year each year. And so they said that they're seeing signals of improvement across their different stores and channels. And in terms of really what we're going to see here in terms of promo, they said that they're typically doing what they always do around this time of year in terms of seasonality and the summer promotions that they do every year. And so those rebates that were sort of pointed out in recent months weren't out of the normal, according to executives here.
All right, Brooke, stick around. Back in April of this year, beer company Bud Light, owned by AB InBev, they released new marketing material with transgender activist Dylan Mulvaney. The backlash was instantaneous, with customers boycotting the brand. The disagreement about Bud Light's next steps following the ad was also wrought with challenges. As companies think about marketing during such a polarized time, what light can be shed on the Bud Light backlash, and what does it mean for marketing moving forward? Let's bring in now Drexel University Associate Professor of Marketing Daniel Korshin and University of Toledo Professor of Geography Neil Reed. And staying with us right now, of course, is Brooke DePalma. Daniel, want to begin with you. This thing seems like it has some legs. This is sticking around. Tensions have been raised, and there could be some long-term consequences here. What are your thoughts?
Yeah, thanks for inviting me. This is really sticking around a lot longer than we normally see for a boycott like this. I mean, usually these things kind of tend to peter out even when they hit a political nerve like this. But here we're seeing, I mean, there's a real galvanizing of support for this. I guess we could call it a protest movement that's partly driven, I think, from some media channels that are, reminding consumers that this is an important issue. So it's really has a lot more staying power than I expected, but I think it's going to be going on for months, if not years.
And Neil, you know, really what's so interesting here is that they're doubling down on saying that we're a beer company. We're here to serve everyone. Do you think that's the right move to make here?
Well, yeah, I think, you know, going forward, they really got to think about, you know, the message that they send to consumers. And I think what they did with the Mulvaney incident is they kind of got out of their lane. And I think they really got to get back into the lane and focus on the fact that this is a beer for everyone. Stay out of politics, you know, stick to the sports and the other types of advertising that we're familiar with. And I think that's one of the keys going forward. But like Daniel said, I don't think they're going to get back these beer drinkers who have basically abandoned them for another product.
Daniel, it seems that Bud Light, AB InBev has kind of walked back some of their comments, and at the end of the day, they're a little bit indecisive. Just wondering how that fits in and how that's affected their marketing campaign in general. Does that put people off?
That's the worst place you can be, is kind of stuck in the middle trying to speak to both sides. And that's been, I think, a big issue. And it's a reason why, in this case, even though they alienated some consumers, they didn't pick up anyone on the other side, because the people on the other side were upset that the company even apologized for having a partnership with a trans influencer. So it's that wishy-washiness that consumers were picking up, or at least that they were thinking that they were picking up. And that wishy-washiness means that they don't really have a strong idea of what the brand is. And I think that's what they were saying in that announcement, the quote that you played earlier, that they need to focus on what the brand is about. I don't think, though, that they can avoid politics altogether. I don't think that that's, you know, in my research, I find that that's not a realistic way to go about it. The trick is to find the issues that make sense with the brand. And here they overstepped a little bit, and they weren't explicit about how this partnership might relate to other things that people know about the brand. And that is part of what caused this controversy to blow up so big.
Neil, let's take a look forward here. I mean, we're on the crux of football season, Super Bowl right around the corner. Where does Bud Light and Anheuser-Busch largely go from here? Do they push more into those Sunday night football marketing, and do they, try to sponsor a little more, come Super Bowl time of year? Where do they go from here, and how do they ultimately gain back that share that they lost with this new reaffirmed key audience in mind?
Yeah, I mean, I think, as I said in my previous comment, I think they continue to focus on those marketing types of efforts which have been successful with them before. I mean, we always look forward to the Super Bowl and the Budweiser ads, and this connection with football has been a very strong one for them. But again, going back to what I said before, they are not going to get these drinkers back who abandoned them. I mean, beer drinkers are creatures of habit, and so those who made that switch from, say, Bud Light to Coors Light, they're going to stick with Coors Light. And Coors Light is very similar to Bud Light. Most consumers could not tell the difference in terms of taste. Pricing is very much the same. So I don't think they can think about getting any of these beer drinkers back. I think the focus now is, kind of keeping out of those controversial topics, or as Daniel said, if they do kind of enter into politics, kind of thinking about it in a more holistic manner. And but I really think they need to stick with what they're good at, which is producing beer and keeping on track with their branding.
And Daniel, when we think about the competitors in the field, first of all, politics has really inserted itself in a lot of brands, but is that something that brands should necessarily avoid? Could it be a good thing? Because you take a look, as you point out in your notes, at their biggest competitor, Modelo, who's now gained and surpassed in market share. Well, they're a little bit political.
Absolutely. They've been very outspoken on immigration from Mexico in particular. And that's been a positive point for them, I think. So so again, I go back and I've studied this for 20 years now and seen the development, and I'm seeing is that customers and employees too, we shouldn't forget other stakeholders. They're looking more deeply about what drives the company, what their motivations are, and they're trying to figure out, as Neil pointed out before, there's a lot of parity in the market, and when there's parity in terms of quality, people look deeper. And what they're looking at is they're trying to find out what is it that makes this company tick. And politics is often
it's a way of, it's sort of like a reflection of what's driving the company, what they care about, and what their values are.
And in terms of, let's talk about sales returning as we edge towards this summer. I think, this question really for you, Neil, as you sort of double down on that consumer, as you sort of say that, we're going to stick to that, do they try again to perhaps, introduce more premiumization options? Do they double down on maybe their, different type of audience that wouldn't necessarily be this Bud Light drinker? Or do you think that really the play here is to just stick to and not maybe sort of offer up a premium brand?
Well, within the US, we've seen this big shift in the last 20 years towards craft, right? So there certainly is a beer drinking segment there who's interested in higher quality product. But I think in terms of Anheuser-Busch, they should, again, I say they stick with what has been successful for them in the past. And again, they can forget about getting these drinkers back. So I think, what they've now got to think about is how can they perhaps promote some of their other brand beers and maybe try to gain some market share with them. And I think that might be one possibility for them.
Daniel, we got time for one more here. Briefly, anything that we didn't cover in this discussion that you'd like to add to the conversation?
I think one thing that we tend to overlook, as I mentioned just a moment ago, is that the effect on employees and distributors. That's something that from what I've read, I have no inside information, but they seem to be very aware of the distributors and how they're feeling about this, how it's impacting them. They've done, from what I've seen, a pretty good job of addressing that. Employees is an issue that we haven't spoken at all about, but these are people that are, if employees get turned off, then they can be not as motivated at work, maybe go to others, and it could help recruiting. So it's a much bigger issue than just the consumers and the market share, although, of course, that's what is driving the revenue.
Yeah, employees are very big and important stakeholders as well. Thank you, Drexel University Associate Professor of Marketing Daniel Korshin and University of Toledo Professor of Geography Neil Reed. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
Direct-to-consumer company Solo Brands is in focus today after posting an earnings beat in the second quarter. This is despite showing a 3.7% dip in net sales year over year as it navigates a difficult macro environment. John Maris, Solo Brands CEO, joins us now. And John, thank you for being here today. Just give us a big picture overview of your company's earnings, please.
Yeah, absolutely. It's been, really to plan exactly what we thought that was going to happen this year. At the beginning of the year, we talked about leaning into wholesale this year. We expected some short-term pressure on our D2C business as we sell in or load in to those retailers. And that's exactly what's happening. So front half of the year, we saw really meaningful momentum in our wholesale retail partnerships and business, really at a time that retailers and wholesalers have been talking about scaling back on inventory. So they're loading in and sending us orders while they're still having to pare back inventory from other brands. But meanwhile, we have seen some pressure on our D2C business as we've done so. Interestingly enough, while our revenue pressure on D2C has existed, we are seeing actually increases in order count in our D2C business. So what we have intended to do was drive customers from retailers back to our sites for accessory purchases. Our Mesa fire pit at Solo Stove has been doing quite well for us. So we're acquiring customers at a faster rate than last year. But again, as we sell fire pits into wholesalers, as we're loading that inventory in, it has created some short-term pressure. So overall, we're right where we want to be for the back half of the year. We see a lot of strength in Q4 as we approach holiday seasons. We also have a big innovation pipeline in the back half of the year. So right now, we feel like things are teed up for a good second half and a good full year.
I want to jump on that innovation pipeline. Tell us what we can expect in terms of products in the coming quarters, please.
Yeah, so it'll start here in the next couple of weeks. In Q3, we've got a really nice lineup. We have not indicated or tipped our cards quite yet on exactly what that innovation is, but Solo Stove will lead the charge with a series of innovation that will come out that is all about creating good moments and lasting memories and helping people enhance their experiences outdoors. So Q3, you'll see some of that innovation come out. It will continue through the first part of Q4 as we approach our holiday selling season, Black Friday, Cyber Monday. So keep an eye out, especially for Solo Stove. When gifting season comes around, we've got some new stuff coming out that I think you're going to really like.
All right, keep an eye out. Want to talk about something you alluded to earlier, and that is the difficulty planning. We have an incredibly challenging macro environment where things seem to change from week to week, but it sounds like you're being somewhat nimble. In fact, you were just saying how you were able to get some incremental, sales from other people's customers as they dwindled their inventories. Just wondering what some of your strategies are around planning for the next 6 months, for the year. Is that possible even?
Yeah, historically, Solo Brands has been a really heavy direct-to-consumer business. Even today, this year, we're 70% direct-to-consumer and 30% wholesale retail. There is easier planning to be done in your retail business because you obviously get POs, you get orders, before you're shipping them. So you get visibility to the future. As we have navigated this and increased our wholesale business, it actually is improving our ability to forecast and to predict our business in the future. Direct to consumer has been less predictable in the past. So we like where we're at. We think, again, this transition to a more omni-channel approach, a more balanced approach, being where our customers want us to be, increasing eyeballs on our brands, is allowing us to be more predictable in our forecasting. As we look to the back half of the year, we feel very, very confident in the guidance that we've provided for the year.
Talk to us about some of the trends that you've noticed evolve and maybe change quite a bit over the pandemic. Changing consumer preferences. We've had a housing boom, a small bust, and now it looks like the housing market is on fire again, but you got people locked in their homes because they got low mortgages. They want to renovate. Lots going on. What kinds of consumers are you attacking here?
Yeah, you're hitting on all the hot buttons for us. No pun intended with Solo Stove. But the reality is that I think the biggest trend that we're seeing, and you're hearing this from others as well, is that consumers care about value. They're looking for brands that are going to give them the biggest bang for their buck, for their hard-earned dollars. They need those dollars to stretch. What we've been focused on is innovation that creates high amounts of value. We are an experiential brand. We're a house of brands that really help you create good moments and lasting memories, as I mentioned. And so if you can trade down from, say, a $5,000 vacation to a backyard experience with friends and family and still create those same types of memories and put smiles on your faces, those are the types of activities that we see consumers attracted to. And so right now, that's what we're focused on is creating an immense amount of value through the products and innovation that we're launching and giving consumers something to be excited about and hopeful for at this time where they need their dollars to stretch.
Really interesting. You're selling goods, but at the same time, it's really experiential. And we've seen the services side of the economy just really hold on here. We got time for one more quickly. Anything that we didn't cover here, give you the floor.
Yeah, absolutely. We've got a lot of innovation, like I've talked about. You kind of leaned into this back half of the year. But acquisition has been really interesting for us as well. We acquired a brand a couple months ago called TerraFlame. It allows us to bring the fire inside or bring s'mores indoors. We're really excited about that and the trend that could create, again, back to the value that we're trying to create for consumers. But as we look to this back half of the year, I think it's the brands that win are going to be the brands that are really focused on delivering great customer experience and creating great value. And that's what Solo Brands is all about. And of course, for us, being that we're still 70% or so direct to consumer, just the free cash flow generation. We're a business right now that's generating high amounts of free cash flow. We're able to reinvest that capital into the business for growth and into that innovation. And I think as you look at our story and continue to follow us, that's the type of thing that you'll see us investing in.
S'mores indoors, that's something I can get behind. So thank you. Really great to talk with you, John Maris, Solo Brands CEO.
Thank you.
Hasbro stock is on the rise this morning on news the toy giant announced its E1 film and TV business will be sold to Lionsgate in a $500 million deal. The second quarter saw strong growth across brands like Transformers and Dungeons & Dragons, but Hasbro warned that the year ahead won't be all fun and games. Thanks to the ongoing strike in Hollywood, Hasbro CEO Chris Cox spoke with Yahoo Finance executive editor Brian Sozzi in our last hour, and here's some of that interview right now.
Big news out of the gate is, in fact, the sale of E1, $500 million. Why did you make the deal now, and where will you spend that money?
Well, we've been Brian, first off, thanks for having me. We've been in a process with E1 for about 9 months now. We announced it back in November. It was just the right thing to do for the company. Hasbro has become great because of play, and we're really refocusing on toys and games. We'll continue to have a great entertainment presence. But when we looked at E1 and we looked at the film and TV division in particular, there was just a lot of brands that we weren't going to make action figures or board games for, and we figured there was a better home for it.
Does this deal, Chris, help you save money?
Yeah, from a high level perspective, we spend about $600 to $700 million a year in film and TV production. Of which, from an operating cash flow perspective, we fund about 50 to 100 million of that from Hasbro corporate. So there will be that upside for us. And then the margins inside of the film and TV division, while it's profitable, it's nominal. So it'll be immediately margin accretive to us as well. And then last but not least, based on the proceeds of the sale, we're going to be able to pay down a minimum of $400 million of debt and accelerate our path to our long-term debt to EBITDA ratio of 2 to 2.5.
Got it. I want to make sure the investor base understands this. Is Hasbro out of the content game? Are you still playing, you still have an eye toward bringing some of your biggest franchises to life on a big screen or a streaming platform?
Oh, for sure. Yeah, the film and TV division is probably about 85% of our entertainment revenue from last year. We still have huge brands like Peppa Pig, a lot of animation efforts, and we have over 30 projects in development across live action and animation, including future movies for Transformers, G.I. Joe, TV shows for D&D, Magic the Gathering, as well as a host of projects for our board games, including a movie that we're developing based on Monopoly with Lionsgate. I think the big pivot for us is we're going to be returning to much more of an asset-light model, where we work with the best and brightest in Hollywood and leverage their distribution platforms and their content creation know-how. And we'll focus on what we do really well, which is play.
Yesterday, Chris, I had a chance to catch up with Intel CEO Pat Gelsinger, and his company is also going through a transformation. But he said something to me pretty powerful, I think. You know that green shoots in his business that started 3 months ago are now morphing into plans. I think he meant the turnaround is starting to take shape. Where does your turnaround stand?
Oh, I think it's palpably taking shape. You know, we entered the year predicting our first half would be down 20%. After Q1, we said it would be down 16%, and after Q2, we're down 12%. Our POS has been picking up through the year. You know, we're still not fully to green, but we're definitely seeing improvements in our toys segment. And our Wizards of the Coast segment continues to be what, in my opinion, one of the best stories in all of games. You know, we see that segment up minimally high single digits this year. And that's on a track record of, I think we have a 5-year CAGR of around 13%. So there's a lot to focus on in terms of our turnaround story and in terms of our momentum around it.
What's next in your turnaround story?
Well, I think for us, it's really for a couple things. On entertainment, we're going towards an asset light model. I think that's going to save us money. It's going to raise our margins, which is important for us. I think in toys, it continues to be driving the innovation funnel there, working with our retailers to be the best execution game in town. And then in games, you know, we're a toy and game company, but I really place the emphasis in games. That's an incredibly high margin business for us, a great growth business for us. And I think you're going to see us lean in more and more there. You know, we've got a $2.1 billion game portfolio with a better than 30% operating profit margin. You know, over the next 5 to 6 years, I'd like to see us make some material progress and continuing to grow that and keep that bottom line super healthy.
Chris, a lot of your biggest customers, Walmart, Target, you name it, are thinking about what games, what toys they will put on the shelves this holiday season. What are you hearing from for them right now? Because as we all know, before we know it, we'll be out shopping for gifts again.
Yeah, well, you're seeing a couple of our favorites right here and some of our retail partners' favorites. You know, this little guy, Furby, we sold out on initial allocations in the first 72 hours. So we think that's going to be a toy of the holidays. We've got some great new Monopoly collaborations. This one's based on Super Mario Brothers, but we did one with NBA Prism, which basically vaporized in the first half of the year. And probably one of the games I'm most looking forward to in the back half of the year is our first collaboration with Mattel on Barbie Monopoly. So taking one of the biggest names in games with one of the biggest names in dolls and really having a nice giftable moment. And then, you know, across the portfolio, whether it's action figures with our hit movie for Transformers Rise of the Beasts, or just other new games that we're doing like Twister Air, I think there's a lot of reasons for optimism in the back half for us.
That was Hasbro CEO Chris Cox with Yahoo Finance's executive editor Brian Sazi. That is it for now. I'm Jared Blickery.